website that tracks them all, and yesterday it was down. I think a lot of people are refreshing it.
Yeah.
But we are likely going to see potentially a final vote on this weekend or Monday.
Do you look at this as a so what? Because then it's got to go to the House, or is this actually going to be an important Monday morning?
I think it's important because I really want to see whether Senator Mitch McConnell backs this legislation. He did back it in terms of a procedural vote to get it to the floor, but is he going to back it in terms of moving this and cementing this as legislation, which is likely going to be very much so something important for the Biden administration? This is definitely going to help President Biden in terms of his economic agenda. The last two administrations were not able to do an infrastructure package, so I think it's going to be very interesting to see who says yay on this vote.
Indulge me for a minute. Lisa, I think you're interested in this too. Senator Warren, speaking to David Weston on Bloomberg yesterday, she said the following: "My concern is that over and over again he has weakened the regulation here." Speaking about Chairman Powell, we need someone who understands and uses the monetary policy tools and the regulatory tools to keep our economy safe. Let's not forget what happened in 2008. Lisa, was that Senator Warren taking a swing at Chairman Powell in a bigger way yesterday?
Yes, I think that could be a very clear message. And also not only doing that, but also backing Lael Brainerd to become the next Fed chair. That was the clear message, at least from my reading of it.
Getting a little bit more interesting, isn't it? Anne-Marie, what's the take down in D.C. about this?
Well, we're still waiting. It's been mum, John, literally from the White House on what is going to happen when Fed Chair Jerome Powell's tenure expires, that term expires in February. And this is really the divide of the Democratic Party. Many say, why change the horse in the middle of the race? Many people agree that Fed Chair Jerome Powell has done a good job guiding the country economically, the monetary policy through the pandemic. But at the same time, this is a chance for the Biden administration to reshape what the chair, what the entire really board of the Fed looks like, and potentially in a nod to progressive left, you could see some more picks that represent America, a little bit more of diversity.
Anne-Marie, talking about internecine issues between the Democratic Party, I want to just veer over to New York State for a minute. Andrew Cuomo, the governor, has come under a lot of calls to resign following sexual harassment claims. He has been very quiet. What's the latest, and how much are you talking about that in D.C.?
People talk about in D.C. in the sense that every single Democratic leader in Washington, D.C., including the President of the United States, Lisa, you saw him there from the East Wing of the White House, asking the governor of New York to resign and step down. Even Governor Cuomo's most staunch ally, the head of the Democratic Party in New York, who has backed him, has said it's time to resign. What comes next? People in D.C. are curious. Obviously, it's not linked so much to the D.C. politics, but the Democratic Party here is backing his resignation. What comes next remains into the control of the New York State Assembly, and that's going to be, they said they're going to expedite impeachment process.
Is there any national significance of Cuomo's resigning or not resigning and the pressure that he's feeling there?
I think the national significance is just potentially because New York obviously is the powerhouse in terms of the economic growth of the United States, also the work he has done during the pandemic. And we also shouldn't forget that Cuomo is under another investigation when it comes to the pandemic, and that is the handling of him and his administration when it comes to the nursing homes.
Anne-Marie Jordan on some important points down in Washington, D.C., our Washington correspondent, thank you. Just to return back to the topic of Chairman Powell and how we reshape this Federal Reserve, I was thinking about this yesterday evening. Tom mentioned Ted Lasso, so let's continue the football reference.
Please.
Oh, boy.
In football, you don't make substitutions when you're defending a set piece. That's rookie manager stuff. Most people who follow the game understand that. At a really important turn in policy, does it make sense, Tom, to change the chairman of the Federal Reserve, considering where we might be in the next 12 months?
Most including, let's say, liberal economists would say you're 100% correct, John. What's so important with Chairman Powell is the change vector over 5, 10, 20 meetings, and everyone agrees he's improved in conveying the message as announced by Clarida yesterday. So not only do you have what you're talking about, but you've got a guy who has the wind behind him. He seems to be doing better.
It, of course, depends who replaces him. And if it's Governor Brainerd, Lisa, I think most people would agree, arguably she is the real brains behind running this labour market a little bit hotter. And I don't know many people that would bat an eyelid if Chairman Powell became Chair Brainerd. But to make those kind of changes at this point in the cycle, I think is really interesting. This is a cycle that's so finely balanced that the opinions are miles away from each other right now in this market. And to make that change at the top of the central bank, That's a big issue.
Well, the indication would be tighter financial regulation, tighter oversight of the banks, because that seems to be what Lael Brainerd distinguishes herself from Chair Powell, and that's the main distinguishing feature that Senator Warren was talking about. But, John, I would ask you this. Is Senator Warren indicative of the mainstream Democratic view? This, I don't know. I don't know how much she's departing from President Biden at this point.
Lisa, in addition to that, do you want to spend your political capital trying to get someone else nominated and through the Senate? Do you want to do that over financial regulation? Is that a big vote winner right now for the electorate, financial regulation?
If you take a look at most of the analyst notes, I'm not going to opine personally, but most analysts expect that Chair Powell will remain Chair Powell come next year and the year after that. However, the uncertainty, I do wonder what kind of premium you can place on this uncertainty. How do you trade around the fact that there could be a changing of the guard at the top of the Fed?
The future's looking good this morning. Either way, futures up on the S&P 500
Always.
up 9. We advanced 0.2% on the S&P 500. Into the bond market where yields are unchanged at 117.86 on 10s. In 2 hours, 4 minutes and about 17 seconds, we will have jobless claims in America.
Launching
The
a
FX
rocket.
market, euro dollar 118.43, positive 0.05%. From New York with Tom Keene, Lisa
Take this,
Bravitz,
John, where you want
Jonathan
to.
Ferro. Thank you, Tom. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here's the price action this Thursday morning. We advanced by 0.2% on the S&P, on a NASDAQ up 0.2, on the Russell of small caps. They've had a tough time recently. We'll try and touch on that through the program a little bit later. Equity futures on a Russell, positive 0.2% as well. We have had a stream of upgrades from Oppenheimer, from Deutsche Bank, this morning from Goldman. Goldman looking for 4,700 year-end. 4,300 was the year-end median price target, but over the last week, the forecast just keep edging higher. Switch up the board and get to the bond market. 2s, 10s and 30s. In your bond market, what a range yesterday. All the way down to 112 very briefly. Took a little look at 121 on the upper end. Right now, 117.86. Yields unchanged. Soft ADP report. A lot of talk about Vice Chair Clarida. The real one for me, a really hot ISM. For all that talk about peak growth, that looked tremendous. Switch up the board and finish on this. China growth fears, restrictions starting to come through. There is an elimination strategy in places like China. Doesn't take many cases to really build those restrictions up. Right. But look at the price action here, Tom. Year to date, your average is 146, 646, 647. Right now, we are 646.18 on dollar China. Aussie dollar, Aussie stronger in the face of all of this. I know it's had some weakness over the last 4 months, some real weakness too. And copper is only down about 0.25%. So, Tom, it's pretty clear to me that the restrictions are building in China. There's a real threat to economic growth in China. Yet the traditional proxies in this market that would pick that up, they started moving months ago. This morning, I don't see much movement at all.
Moving a little bit here, and the metric there, folks, for those keeping score is under 6%. We've got a really important guest right now, but we've got to get to this headline first because it is germane to what John Farrow was saying about China. This is Moderna out with a 93% vaccine efficacy. And Lisa, really, really important to see that out 6 months. What's so important here is what we heard from Johns Hopkins 2 days ago, Lisa, that in their opinion, this is Dr. Breyer, if it isn't Pfizer, if it isn't Moderna, don't do it. That's what we need.
The idea here that not all vaccines are equal, in that some are more efficacious after a longer period of time. Look, the question that a lot of people are wondering, Tom, is will boosters be necessary? If these mRNA vaccines are still completely effective, and 93% efficacy seems pretty effective after 6 months, does this negate the near-term need for boosters? And what does that do for the profitability of some of these pharma companies? But also, just in general, how secure does it give the recovery in terms of footing?
Moderna managing the message this morning with huge revenue and huge profit growth. Right now, a joy after Clarida and before this important labor report, the gentleman who definitively restructured our knowledge of wages 20 years ago. David Blanchflower is with Dartmouth, professor of economics, always controversial, his public service to his United Kingdom years ago. Professor Blanchflower, do you see any indication of wage growth or wage inflation, I should say, with the nascent inflation we see?
Well, the measured wage growth in many countries is really high. In the UK, the latest number is over 8%, but you shouldn't believe that. The reason is because we've got, well, first of all, you've got these base effects, but secondly, you've got a big chunk of the wage distribution at the bottom that's dropped out. So the wage data itself is not very believable. So the question is really what's happening to wages? The total compensation numbers in the US this week are in the 2.9s or so. I think the answer is that wage growth is pretty benign everywhere. If you look at settlements in the UK, and CC Rouse has a blog on the White House blog saying she has every expectation that wage growth is going to go negative shortly. I don't know whether that's true, but I see no real reason to believe wage growth is very strong at all. I mean, there are bottlenecks and there are shortages, but you know, on your program, I've said so many times, if there's a shortage, then you raise the price. And we haven't really seen lots of evidence of that. So we're in adjustment mode. We're in mismatch mode. You know, there are jobs in some places and workers available.
Right.
But I don't think really that at the moment we should
Right.
we believe that wage growth is a big problem.
Danny,
Yeah.
how do central bankers make strategic adjustments? Did they take a moving average of 3 meetings or 4 meetings or 5 meetings? Or can one meeting like we see, one labor report like we see here tomorrow really change the behavior and belief?
Well, that's a great question, Tom. I mean, I set rates 36 times. And my view was always what essentially is going to happen in 2 years' time? And is there anything that's come in the last 4 weeks after the prior meeting that changes my view? So that's the situation. One piece of data. I mean, I heard a governor this week say what happens in the next 2 meetings is crucial. Really? That seems most unlikely. So I think the answer is that in this world of great uncertainty, if you're pushed by what happens in 1 or 2 meetings, you really haven't got the plot. What's going to happen in 2 years' time? Does a small change in inflation or a small change in the labor market report fundamentally affect what you think is going to happen in 2 years' time? So if it does, then you're really not doing it right. I think one meeting in this world is really not going to tell you much. There's enormous uncertainty. You don't know what's going to happen to the path of the vaccine. You don't know what's going to happen to long-run changes in behavior. So your right response is to say, we don't really know. And I do think it was pretty silly. I have Carida say yesterday, I met other Fed governors say really pretty silly things. To what extent does one report change what you think is going to happen in 2 years' time? Powell's made it very clear that temporary changes in inflation today really are likely to have no effect in 2 years' time. And that seems like the right attitude. How does it affect things 2 years down the line? Because Fed policy, Bank of England policy takes a time to have an effect. And I think we've heard a lot of really rather silly stuff from governors and bank presidents and people around the world in this very uncertain time.
Danny, I think we understand your position, particularly on rates. Let's talk about the asset purchase program now. The wonderful Michael McKee, our good friend and colleague, always in that news conference, asking some version of the same question, which is what can we get for 120 billion a month in asset purchases that we can't get for 60, we can't get for 50, we can't get for 40, maybe we can't get for 10. What can we get for that?
Well, less than we originally got, but monetary tightening is monetary tightening. If you go from, you're buying a 10 billion a month and you move to 5 billion a month, that's monetary tightening for an economy that's adjusted. When you say to me, that's my opinion, but I don't think it is an opinion in a sense that monetary policy has an effect in a while, 18 months to 2 years down the road. And an economy that's adjusting, you need to help it to adjust. So more is better, less is worse. So I think marginal things are impacted, but a small change downwards is tightening in an economy that is trying to recover. So the answer is maybe not a lot, but why would you? It's like saying, how hard would you like me to kick you? And you say, well, I prefer you not to kick me at all.
Well, but Danny, there is a question about how much this is actually affecting one of the key metrics that the Fed and other economists are looking at, which is the participation rate in the U.S. labor market. Stubbornly low, 7 million jobs still have not gotten back online after since the pandemic really began. How much can Fed policy at this point really affect what has been a downward trend in the participation rate in the United States over the past 3-4 decades?
Well, I think Fed policy has been responsible in many ways for its decline. I think it's held the economy it's basically had policy too tight. I mean, the comparison you want to draw is, let's say, take the participation rate or the employment rate and compare it to everywhere else. So if you look in 2000 and you go to the UK and you say, compare the UK's participation rate with what it is in 2000, the answer is it's higher. In the US, it's about 5 points lower. Well, what's that to do with? What explains that? Well, it's nothing to do with aging, because some people have argued, because that's the same everywhere. Nothing to do with technology, because that's the same everywhere. So the probability is that fiscal and monetary policy have been too tight, and there's been too few incentives for people to go to work. So the answer is that, the Fed can have an effect on it, but we have to try and think about why is it that employment rates and participation rates in the US have declined, whereas basically in every other country in the world, including Italy and France and countries that have had high unemployment rates, have had the opposite. So presumably it has something to do with incentives to work and Fed policy being too tight, and Fed policy since 2015 when they raised having a major impact on the participation rate. So I think that this looks like major error on the part of policymakers. It's nothing to do with anything else.
Danny on form this morning, the rarely outspoken Danny Blanchflower of Dartmouth. Danny, good to catch up with you, sir. Good to hear from you, buddy. Thank you. Thank you very much. Let's touch on that ISM out from yesterday. Just want to get to the industry comments. Highly anecdotal, but I think it speaks to everything we talk about every single day. We have this situation where demand continues to outstrip supply. This is the commentary, Tom. Quote, costs have risen dramatically in the last 45 days. Labor shortage continues. Increased pay, but the shortage continues. Continued shortages, additional delays. You just keep seeing that commentary everywhere you look in the U.S. economy right now, Tom.
And John, even with what you just said, it's dated. Even that ISM survey to me is dated. So much has moved in the last week. And I would use as the proxy the pandemic industry, which is air travel in this nation. John, I had a 4-hour wait on American Airlines yesterday on the phone. That's a massive dislocation of demand for air travel versus what they can deliver. And imagine what it's like down south where you get serious hospitalization numbers.
And Lisa, are there any signs that anytime soon those supply issues, those constraints will heal?
It's unclear, however, just in spite of this, it's worth noting, and in spite of the increase in Delta variant, we did see a record growth in this U.S. ISM services data. So just to give you that sense.
Really hot.
Really hot, even though we had all of those other caveats.
And that's got to be the real story behind that pop in yields at 10 Eastern yesterday. From the talk of Vice Chair Clarida.
Yeah, I mean, you put those two things together, how do you really parse them out? They both came out at 10, but yes.
I was in the surveillance nap.
I know exactly where you were. 118
Nap.
on a 10-year. Yeah, right. Nap. Yields unchanged on 10s. Your equity market up 9 on the S&P 500. We advanced 0.2%. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. JP Morgan reportedly is pitching a Bitcoin fund to wealthy clients. According to CoinDesk, customers of JP Morgan Private Bank are being offered a passively managed fund in partnership with NYDIG. NYDIG is a Bitcoin-focused platform that's a subsidiary of Stoneridge, an alternative asset manager. CoinDesk says there are no investments from clients yet. Landlords have gone to court to challenge President Biden's extension of the coronavirus eviction moratorium. The Alabama Association of Realtors says the move goes against a ruling by the U.S. Supreme Court last month. The president had warned the extension could be challenged, and he urged lawmakers to come up with their own. And 2 senators propose using unspent state COVID aid funds on infrastructure. Republican Senator John Cornyn and Democratic Senator Alex Padilla are bargaining with the White House. If they can make a deal, it could free up billions of federal dollars for the states. And New York Governor Andrew Cuomo is struggling to hang on to power. Cuomo stayed inside the executive mansion yesterday, a day after the state attorney general released a report outlining 11 cases of harassment towards women. Cuomo has denied that he will step down despite calls from former allies urging him to quit. And barbecue grill maker Weber cut the size of its IPO in half and priced shares below a marketed range. The company raised $250 million and has a market value of less than $4 billion. Since 2010, it's been majority owned by the BDT Capital Partners. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Let me say only that we do not believe that the Delta variant will lead to another broader-based lockdown in important countries or regions, so that is not part of our forecast.
Marcus Kuhnert there, the Merck CFO from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Here's the price action this Thursday morning. Your equity market pushing higher by 10 points on the S&P. We advance about 0.2%, just off session highs. Yields going nowhere. 118 into jobless claims a little bit later this morning. Outside of that, into the FX market, euro dollar also unchanged at 118.41. Crude a break of 70 in the last couple of days, back to 68.23. Call it 68.22 on WTI. We're positive there, about 0.1% on the session. Some news out in the last 30 minutes from Moderna. They say, Tom, that its COVID-19 vaccine remained 93% effective through 6 months after the second shot. Just an update on the efficacy, 6 months after the second shot. That's from Moderna. The number, 93%.
We're learning as we go. Right now, what I'm hearing from so many people, anecdotally, thank you for the tweets and the emails, we love getting them in, is you really like that we talk to experts on your fears of the variants. Gigi Granville, senior scholar at Johns Hopkins Center for Health Security. And what is so important here, folks, is Dr. Granville is one of the nation's leading protein chemists with her work at Memorial Sloan Kettering over the years. Gigi, I'm going to cut to the chase. We're not going to make this Leninger's 101. There's Delta variant, there's Lambda variant, and there's the spike protein. What do our listeners and viewers need to fear?
Well, they don't need to fear variants. They're not magic. From a broader perspective, from public health, these variants are making the disease harder to end. It's making the pandemic harder to end. But all the things that you can do for Delta, all the things that you should have been doing for Alpha, they still work. you still need to get vaccinated, use a mask in areas of high transmission, really pay attention to air quality, get HEPA filtration devices for classrooms and public spaces, and you should be okay.
Within the spike, and let's not get into DNA, mRNA, and the rest of it, and the very fancy Greek letters of your world, do the vaccines that we have now, do they have a confidence to carry over to these other variants, or should we worry about it like we worry about, say, Staphylococcus in the bacteria world?
Right. Yeah. So it is a concern, but it's not something we've seen yet. And so people don't need to worry that their vaccines are not effective. Right now, what we're seeing is that, there might be some fewer antibody responses from one variant or another, but the vaccines are good. Thankfully, your immune system is a little more complicated than just one way of measuring it. And your immune system, we're evolved creatures. We've been going to war against infectious diseases for a very long time. So, we're going to be okay as long as you get the vaccine. And if we need to have an updated one, that will happen at some point in the future. But things look good right now.
We're evolved creatures. I like that. Some of us are. Dr. Gronvall, there is a question also about the booster shots, because especially as we hear from Moderna that their mRNA vaccine remains effective 6 months after the second shot. The idea here of 93% efficacy basically being nearly the same as initially. Does this basically remove the need for near-term boosters and lengthen the recovery time that we could potentially have economically and socially?
So just to clarify, so they saw that efficacy 6 months out. That doesn't mean that the vaccine only lasts for 6 months. We think that the vaccines will last potentially for years before you might need a booster. And yes, you're right. That probably means that for most people, they will not need a booster. I think most people are thinking boosters might be necessary, or probably will be necessary, for people who have immunocompromised positions, conditions like they might have had a liver transplant, or they are very elderly, or they have some other condition that is going to lead to them needing to have a booster shot.
Meanwhile, that's good news. On the bad news, the vaccine has not prevented the spread of the Delta variant. Is it a futile goal to try to eliminate the circulation entirely of these viruses?
We're not, so any talk of eradication, just put that out of your mind. It's not going to happen. This is a virus that's call it a generalist virus. It infects other animals. People have gotten infected from animals, from mink. It's gone to mink and back, and it probably has gone to pets and back too, but we haven't seen that yet. So that's not going to happen, but we can make it something that is not going to cause people to go to the hospital. And that's really, what we need to be focused on. We need to prevent morbidity and mortality.
Dr. Gronvall, John Farrell's really focused on China, the dynamics of this pandemic in China, and we've had reports from experts there that this time is different. How do you interpret the size, the scope, the scale of China and their ability to contain, to diminish hospitalizations and deaths?
China has some ability to move in different directions and require things that other places do not, but humans are the same everywhere. And I think people have a natural tendency to congregate. And so that's going to be a challenge in combating any infectious disease that is passed from person to person. And it can be counterproductive if you're not fully getting all the information that you need. But yes, this variant is definitely more challenging than others because people have a lot more virus in their nose, and they're breathing more out. And so they're infectious for longer. And so that's why it's going to be a challenge for even countries that have done very well with the disease so far.
Doctor, always enjoy catching up with you. Thanks for your time this morning. Dr. Gigi Gronvall there, Senior Scholar at the Johns Hopkins Center for Health Security at the Bloomberg School of Public Health. Moderna ran in the last 30 minutes saying that its COVID-19 vaccine remained 93% effective through the 6 months after the second shot. That stock, which is a pure play on this mRNA technology, that stock is up more than 300% year to date, Tom, after a more than 400% gain last year. The run on this name has been unreal over the last several years.
John, they're managing this. For those of you on radio, it's real simple. Stasis through the pandemic. We get into February, March, and then June we begin a moonshot higher from, call it 100 up to 450. And John, they've got to manage the capitalistic and share return message here with the medical immediacy. They're all doing this, particularly Pfizer and Moderna.
I like that phrase, moonshot, because, Lisa, on that chart, I think that is the appropriate phrase for a stock that is up almost 2,000% over the last several years.
But isn't that the story of biopharmaceutical stocks in general, that basically they put a lot of money into research, and this one was mRNA research that actually paid huge dividends, improved its use case in a mass, very public stage. And this, to me, is sort of the dream case for a biopharm company.
Stock's a little softer in the pre-market, down by 1.2%. I'm sure that won't keep you awake tonight after that story of the year-to-date gain of more than 300% if you hold that stock. Your broader equity market looks like this, up 8 on the S&P, advancing 0.2%. Your bond market yields in about a basis point to 117.36. In about 5 minutes' time, we will have a Bank of England rate decision. We'll bring you the breakdown of that in just a moment. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz and Jonathan Ferro. For our audience worldwide, this is Bloomberg Surveillance.
Is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg Bloomberg.com webinars.
Over the next 10 years, we will have a recession. And when that happens, earnings often drop 30%.
I think the market can still move higher. It's just going to happen more on the cyclical side.
A pullback in yields could cause some of that volatility.
The Feds have not spoken about this, but they will not be happy to see the 10-year approaching 1%.
Our base case is that they tee up tapering perhaps as early as the November meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Payrolls Eve from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market futures positive, 0.2%, up 9. The big bull on the street right now, Tom Keene, is David Kostin of Goldman Sachs.
Well, there's a readjustment. He's got some company out there at 4,700. But what's really important, John, is he migrates out strongly into next year with a real statement on end of 2022.
4,700 this year. 4,900 next year, 7% upside into year-end, 11% upside into 22 year-end. And Tom Keene, a market that apparently will have stable interest rates. Your thoughts on that?
Well, you know, the stable interest rates are there. He's talking about that. He's talking about earnings growth. And I'm going to bring it over to someone way out front on double-digit optimism, and that's Ben Laidler. And the common theme of Laidler, Kostin, and the other bulls is, yeah, interest rates matter. Yes, the Fed matters. Yes, the jobs report matters. John, what really matters is what are corporations doing?
What are corporations doing right now, Tom? They're making money and margins are looking good. And Lisa, the big story, I think, for the next 12 months is can they continue to keep those margins insulated?
And actually, I was speaking with Gina Martin-Adams. We all were yesterday of Bloomberg Intelligence, and she was saying that people have actually underestimated how much margin pressures have come in with S&P 500 company earnings in the second quarter, that basically those margin pressures are increasing more than she had previously expected. The other question I have is, how much does this corporate strength reflect economic strength, and how much are these unique stories, John?
Would you like to get to the Bank of England rate decision? Would you like to rattle through that?
I think it's thrilling.
I know you've been excited. Interest rates unchanged, Tom, at 10 basis points. The asset purchase program, both the corporate and the gilt purchase program, those targets, they are unchanged too. The vote was split, though, 7-1. Some people were looking for 6-2. Dave Ramsden, Michael Saunders, they were looking for dissent there. They got just one dissent from Michael Saunders on that asset purchase target. 7-1 to keep bond buying target unchanged. So just a little bit of dissent starting to come through a bit more formally over on Threadneedle Street, Tom.
Does the Bank of England governor have the same power as Chairman Powell?
With regards to what, Tom?
Life in general. I mean, do they have the same oomph?
They have the same approach, apparently, because the Bank of England sees inflation of 4% in 4Q, and it will fall back close to target from there. That sounds like the T word to me, Tom, over at the Bank of England. So they share the same language.
They can
Do we agree on that? Cable 139.12, basically unchanged off the back of this. We're still positive by 0.2%. Euro dollar a snooze fest too. I can run through the price action for you now after we got through the Bank of England. I just knew you were so excited about that, Tom. Euro dollar 118.44, positive 0.06% into the bond market. Not much change here either. 117.86 on 10s. And in the equity market, Lisa, we keep grinding, don't we? We keep grinding higher, up 8. We advance 0.2%.
And I will say, as we grind higher, what is the incentive to sell equities if you have the likes of David Kostin over at Goldman Sachs saying it's only going to go higher over time, even if there is some volatility in the meantime? And perhaps that's keeping price action elevated where it is for the time being. What we're looking at economically in about 90 minutes time, 8:30 a.m., U.S. initial jobless claims. The expectation is for a decline to 383,000. This, to me, is a question. A lot of people dismiss this figure as being noisy, irrelevant over the past few months after the pandemic and some of the assistance programs. Do people start to attach more weight to this, to the stubbornly high pace of jobless filings over the past few weeks, despite the fact that there is such a robust labor market? Then at 10 a.m., Fed Governor Christopher Waller is giving a speech on central bank digital currencies. A lot of people are curious about whether there could be a Fed coin. But Chris Waller has also been a little bit more hawkish, talking about how if there is a pretty hot labor market over the next 2 months, that he would be okay with indicating as soon as September some sort of announcement about tapering bond purchases. I'm curious if he talks any more about what the parameters are for that. And 3 p.m., President Biden is planning to call for half of the vehicles sold in the United States to be emission-free by the end of the decade. How much will this require policy initiatives on the part of the White House? How much will some of the big auto manufacturers in the United States back this? And any guidance as to money that's going to some of these electric charging stations and other initiatives will be interesting to the market, John.
Elisa, thank you. What to look out for? Tom?
John, I'm upset. What is a Fed coin based on?
No idea.
No, are you kidding me?
Are you that upset about it?
Yeah, I think this is nuts.
No, I think that there is this idea of why should there be a bank as the intermediary between the U.S. government and individuals? If people basically are using digital money anyway by nature of paying things on Venmo, why not have a sort of central depository? And this, I think, has been a very controversial issue for financial institutions.
Are you two in an argument right now? I can't tell.
John, it's a marriage, John. What can I say? You can't tell.
Cable 139.42, approaching 140 on the pound against the US dollar. Very close.
Lisa, just say Hermes and it'll work out.
I'll just keep talking to myself.
Thank you.
The Bank of England sees a modest tightening over the forecast period as likely necessary. You'll hear from Governor Bailey at the top of the hour in about 55 minutes time or so, so look out for that. I want to bring in Gene Tenuso. Gene, it's just you and I now, the Columbia Threadneedle Investments Global Head of Fixed Income. Gene, let's work through this bond market. Real yields were negative through 120 yesterday. Can you get your head around that, Gene?
Well, look, it's where the Fed has placed interest rates at this point in time. And what we've seen in the last month is that data have started to disappoint relative to expectations in the first time really since May of last year. Data are still good. The economy is still growing. We saw second quarter GDP with personal consumption at almost a 12% annualized rate. But now expectations have become high enough that it's hard for the real data to exceed those expectations. And you layer on the additional uncertainty around the Delta variant and the potential that we could have additional restrictions. It's not changing the growth story. It's just delaying our return to normal, so to speak, by, we think, a month or two.
Okay, delaying by a month or two, then why do you think that 10-year yields could retest a 1% threshold?
Well, it's a very important juncture right now. We have a lot of workplaces planning to return to the office after Labor Day. We have a lot of schools planning to return to in-person learning. And if those plans are disrupted, particularly students in school, that means parents have to stay home in a two-income household. That delays a return to the labor force for a lot of the population. So I think these are things that can give the Fed pause, and the Fed believes they have flexibility. They do not believe, even though they seem dead set on tapering, I don't think they're dead set that it has to be a Jackson Hole or September announcement. I think November could be a very reasonable announcement. And in that intermediate period, we could very easily retrace a little bit lower.
Gene, what's the new 60-40 split? I don't have a clue. None of this is in the textbooks. I used to be easy, 60% in equities, 40% in bonds. The sophisticates went 60-30, 10% in cash. It's out the window. What's the new mix?
Well, I don't think it's cash, Tom, because cash is guaranteeing you one thing, which is a 0% return. I think a balanced portfolio still makes sense, but I think there's a replacement now or a new safe haven for government bonds, because government bonds now are purely a policy instrument. And now we can look at things like high-grade corporate bonds, investment-grade MBS, a high-quality municipal portfolio, and I think that ought to be the core of a fixed income allocation rather than traditional government securities.
Gene, tail risk, let's talk about that just quickly. If a headline crossed the Bloomberg in the next couple of weeks that said something like the return to school and person-to-person learning was delayed somehow for the month of September, what would that mean for this market?
Well, look, I think it does mean we can push below 1% on the 10-year. That does mean we get exceptionally low and even lower real yields, to the point earlier, John. But I think this harkens back to like a 2012 type scenario where the economy was still improving. The Fed had yet quite to taper or tighten, and real interest rates continue to grind lower. It seems counterintuitive, but it's not that unusual into a recovery as the Fed has yet to catch up to where the economy is.
So, Gene, final question from me. If we do get those supply constraints easing through September, return to school happens, we start to see people turn up for the jobs that are advertised in a bigger way. What would happen to tips? What would happen to real yields if everyone woke up and said, okay, we no longer need that inflation protection. We don't have to pile into tips in the same way. What would happen to real yields?
I think there's a lot of upside to real yields. And that's a painful environment for tips. And I think it's one that confuses investors because they say, look, it's an inflationary environment. We can see the CPI prints. We'd expect that tips as an asset class to do well. The truth is, in that environment, tips would really get run over. And I think it's a risk to, tips, but also other high quality fixed income, which is why I still think it makes sense to have a more moderate duration profile as we head towards the fourth quarter.
Smart, Gene. Always smart. Good to catch up, sir. Gene Tenuto, Columbia Threadneedle Investments Global Head of Fixed Income. Lisa, what to think about as we get deeper into this year, deeper into the back end of this year? If people suddenly wake up and start seeing this data that spells out a stronger message that says, okay, a lot of this is going to fade, we've piled in a massive way into tips, in a monster fashion. That unwind could be brutal.
Which really, I'm wondering, when you talk about real yields turning more positive potentially or turning less negative, what's the read-through effect on stocks? It kind of depends on where that increase in real yields is coming from. Is it the nominal, or is it in the tips market that a lot of people have discounted as perhaps a bit distorted?
Well, let's be clear here. That 4,700 at Goldman, Tom, for this year, the 4,900 at Goldman for next year, a lot of that leans on some stable and low interest rates going forward from here.
Yeah, it does. We've got a chart on that. I think we've constructed this up, folks. And John, it puts into scale. For those of you on radio, you take a vector of this, John, and you fold in, what we see on earnings and the rest of it. And then you go out to the end of this year, the end of next year. And I'm sorry, John, Constance call is just pretty linear, more of the same. It's not a jump condition.
As you were, we keep climbing. Coming up at 8 a.m. Eastern Time. In about an hour from now, we'll catch up with Seema Shah, Principal Global Investors Chief Strategist from New York City this morning. Good morning. Higher forecasts keep coming through. We've had it from Oppenheimer, we've had it from Deutsche Bank, we've had it from Goldman Sachs this morning. Equity futures up 7 on the S&P. We advanced by 0.15%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is laying out an ambitious goal today. He wants half of all vehicles sold in the U.S. to be emission-free by the end of the decade. Automakers say that can only be achieved with a bigger government investment in charging stations and other infrastructure. China has imposed new travel and movement restrictions in an attempt to stop the spread of the Delta variant. There have been more than 500 symptomatic cases so far. Public transport and taxi services were curtailed in 144 of the worst-hit areas nationwide. In Beijing, train services and subway usage was limited. And more than 150 wildfires are raging in Greece today. Authorities ordered more evacuations from an island near Athens. Firefighters are being hampered by temperatures over 100 degrees and strong winds. Fires that had threatened the outskirts of Athens earlier this week are now under control. And Glencore says it could dramatically increase returns to shareholders going forward. The company is cashing in on the high prices for the commodities it mines and trades. Glencore announced almost $1.2 billion in dividends and share buybacks today. Surging metals prices drove first-half earnings to a record. The Biden administration has approved its first arms sale to Taiwan. It calls for selling 40 self-propelled howitzers to the island, along with kits to add GPS to the shells the vehicles fire. The $750 million deal is almost certain to be denounced by China. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
anos sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo Milton Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem pros amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
If the outlook for inflation and outlook for unemployment I summarized earlier turn out to be the actual outcomes for inflation and unemployment realized over the forecast horizon, then I do believe that these three necessary conditions for raising the target range for the funds rate will have been met by year-end 2022.
Did you get all that? If the outlook is the outcome, then this is what we'll do. That was Vice Chair Clarity yesterday. Pretty straightforward stuff. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your equity market. We advanced 7 on the S&P, up a little more than 0.1%, off session highs. Yields in now by about a basis point to 117.20. Had a little look at 112 in yesterday's session, then bounced back off the back of a really hot, strong ISM, 117.03. Euro dollar unchanged, Tom. Basically, euro dollar positive 0.09% to 118.48.
And the VIX speaks to a resilient market, 17.76. John and Lisa have got all sorts of things to do in Washington. John said to me, well, take this where you want to, so I am. And with Jeff Fitzpatrick of Bloomberg Government, our international and indeed national audience needs to know a very subtle shift that occurred in Biden politics yesterday. And Jeff Fitzpatrick, that is the reaffirmation of the center of the Democratic Party, the important election out in Ohio. The left, the progressives went down in flames, and the center holds. Explain that.
Yes, this was an interesting race in the Cleveland area in which
I guess establishment candidate did end up winning. The more progressive aligned member, I'm not sure how much of the race speaks entirely to all national politics and more the personalities involved. A series of statements, a bit of a history that had put people off there. It seems like a bellwether at first. For people who want to say,
Jack, you sound like you're speaking to consultants. Look, Jack, it's real simple. This is a story. It's a narrative. I got a narrative in Cleveland, and I had a narrative with the mayor's race in New York as well. The Democratic Center has been the surprise of this mid-year 2021.
For the electoral results we've seen, I think that is safe to say. I would point out that as Democrats have focused on what they want to accomplish early in the Biden administration, the center and the left really seem to be closer together than you would imagine from watching what you've seen on the campaign trail. In the major priorities that Biden has pushed, the stimulus that came out, the infrastructure bill, the next big bill, he has essentially followed Bernie Sanders' lead and then allowed the centrists to pare that down. But for the most part, the Joe Manchins and the Bernie Sanders types have been much more close together than anything you would have imagined if you were watching the New York mayoral race or watching campaign politics.
But Jack, has it been effective? I've been reading a lot of analyst notes that put the chance of that $3.5 trillion plan getting passed by Democrats as basically a 50-50 potshot.
It's hard to say whether it's a 50-50 potshot because they could pare it down more. That absolutely might happen. But we're still talking about trillions of dollars. We're still talking about a push by Democrats and by the mainstream to increase the corporate tax rate, to increase taxes on the wealthiest earners. I don't know if it's a 50-50 shot, but they absolutely could succeed if they're still willing to make some concessions to the center. And what we've seen so far, again, in a couple major instances with a couple $1 trillion involved, is both wings of the party understanding that they need to be essentially unified. Legislatively, it's been basically a unified party lately.
Meanwhile, we're looking at an economy that still has not reached full capacity and still has a lot of room to go, specifically with the labor market. People looking towards September and kids going back to school as a key moment. What is the Biden administration doing to ensure that kids do go back to school in person, considering the fact that suddenly people are raising that as a question now?
That's been one of the tough points for the Biden administration throughout this. That is not right now seemingly a major focus from the federal government. What we've seen from the Biden administration lately in terms of responding to the Delta variant when it comes to schools, mask requirements, that kind of thing, is a little bit more hands-off than early in the pandemic. The latest news on the potential for vaccinating kids under 12 is probably where the most potential is there, but I don't think we are on the brink of concrete actions by the federal government on schools right now, it seems.
Jack, appreciate your time, sir. As always, Jack Fitzpatrick down in D.C., our Bloomberg government reporter. Looking forward to Payrolls Friday, just around the corner, about 25 hours away. Here are the estimates. 870,000 is your median estimate. At the top end, 1.2 million. At the low end, 350,000. Just coming down a little bit, Tom, as this week grows older.
Agree.
We tick down from about 950, 925, all the way into about 870.
Delta variant is what it's got to be. I see it permeating every discussion. Jonathan Englander's note at Standard Charter this morning was just brilliant. You mentioned Kit Jukes all fired up, and many others trying to mix this medical story in with economics, and it's pared back a little bit this week.
Lisa, once again, just a massive range for estimates into Friday.
And yet, analysts trying to show how this actually still is important. Steve Englander of Standard Chartered, I know you picked up on this earlier this morning, John. This idea that if we get the consensus of 875,000 additional jobs, This actually could be a hawkish surprise in a certain way, at least as perceived by markets, because it could mean that the U.S. labor market is on track and that the Fed will be more okay with tapering in the nearer term. I think that's interesting. I mean, again, the reaction function in markets to some of these numbers, John.
Here's the quote from Steve and the team over at Standard Chartered. We think investors underestimate the likely impact of U.S. employment data to be released tomorrow. The consensus is 875 rather, now down to about 870. If hit, could stoke hawkish expectations despite being consensus. So consensus is the surprise potentially tomorrow, according to Standard Chartered.
John Ian Lingen publishes moments ago. He's on often just wonderful, wonderful morning note, really hyper acute. And he says Delta variant, maybe that overcomes anything about jobs.
You think that is the number one issue right now, Tom? I think a lot of people agree with you.
No, I don't agree. I'm not there. I'm not with Lingen on this. I think there is a real economic
Well, that's setting the
power
stage
going up.
for a delay of a return to normal. It's pushing things back.
It makes
maybe a month or so, maybe two.
It makes the x-axis a complete mystery, particularly around school, as Lisa mentions.
There's a bullish take as well, just to be sort of contrarian here. That is that it's accelerating the move to get vaccinated, that you're seeing more people getting vaccinated in the harder hit areas where less people had gotten vaccinated previously. This is actually potentially going to end things.
We're all just in shock.
On a faster pace.
You know, John, we gotta let the story out. The consultants have come in, and the first thing they said is Lisa's gloom is just too much. It's the pendulum of consultants that shifted the tone of this show.
No, I'm trying to look at the derivative effect of Delta.
Oh, really? Chicago liberal arts
Is it something
does
to
math.
fear or a reason to be optimistic because we're correcting course? One or the other. I'm just shocked that you said something optimistic. Thank you. Thank you.
What you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives. And you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high. So, and that's all because of the lack of supply, just disruption.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here is the price action this Thursday morning. Equity futures advanced by about 0.2% on the S&P. On the Nasdaq, on a Russell, we're up about 0.1%. More broadly, here's the story over the last week. A series of upgrades from Oppenheimer, from Deutsche Bank, and this morning from Goldman. Let's work with the Goldman call. Looking for 4,700 year-end, looking for 4,900 next year-end. So 7% upside from where we are yesterday, 11% upside into year-end next year, and on what? Better earnings and low and stable rates. So let's work through it. Get to the bond market, switch up the board. 2s, 10s, and 30s look like this. Your 10-year yield, 117.36. Big range intraday yesterday off the back of that really hot ISM. Can we stay low and stable? Most people expect yields to go higher from here still. Year-end forecast, median, 180 in our survey.
Is it 180? 1.80?
180 from here at 117.36. BYFC on the Bloomberg terminal, Tom.
Thank you.
For your bond yield forecast. No problem. 180 from 117. Is that low and stable? Will that even happen? This is the one for me. Switch up the board and get to this. It's a chart of the ISM. The ISM yesterday, the ISM services read was at a record. At a record. If we can keep this kind of pace up, anywhere near this kind of pace into year end, Tom, if we get the kind of capitulation maybe, if you get the supply side response in this economy, when you really think about it, lift the lid on the ISM yesterday, demand outstripping supply. That was the story, wasn't it? Demand outstripping supply. We have really robust demand in this economy. At some point, for many people, they would argue at some point, yields have got to go higher. Now, it's not my argument, Tom. We've all heard the same argument a million times and yields have gone lower. But surely, in the minds of many, yields have got to go higher. What does it mean for the Goldman call then?
Yeah, exactly, exactly. This is really important, folks. We're going to stop the show here because John has put a sum together, which is the x-axis. Costin has gone, John, more optimistic because he's got a greater belief in the trajectory of the economy out through 2022. And you wonder how that will dovetail down the road when Jan Hatzius sees the microdata to be able to make the call, and will Hatzius extend out his call towards a 3% GDP economy? When will they link up?
Let's be clear here too, Tom. The equity market can perform tremendously well in a rising rate environment. In a rising Fed fund rate environment. We saw that in the previous cycle, 2 cycles ago. We saw that in 2013 too, in a big, big way. But I do just wonder, Tom, if you've got a call out there at the moment on this equity market performing really well on low and stable rates, I do wonder at some point we should have some capitulation, shouldn't we? At some point. I just wonder how that reshapes those forecasts going forward from here.
And that's the mix, as Tobias Lefkovich told us yesterday.
Yeah, Tobias down at 4,000 on the S&P. A debate that we can continue having.
We can.
City finally balanced as we try and work out where we go next. That's the cross-asset story. Let's get you some movers too. Morning, Romain.
Hey, good morning, John. When we talk about the movers here, a lot of individual stories. Biggest volume mover out there once again today is Robinhood. Of course, you saw that 50% pop yesterday. In fact, almost an 80% pop on an intraday basis. A lot of that had to do with the fact that options actually finally started to trade. Those shares, though, down about 10% here in the pre-market as a lot of those SEC filings start to pile up, as those insiders start to cash in a little bit on this. So a little bit of a back and forth, a little bit of a seesaw on what is now, of course, one of the most popular stocks out there. Also popular this morning is Ford. That's actually your second biggest volume mover. Of course, Joe Biden, the president of the United States, expected to have an event later today in Detroit announcing an ambitious plan to make half of all of the cars made here in the U.S. emissions-free by the end of the decade. Seeing a little bit of a bump today in Ford as well as GM. Both of those companies will be at the event, as well as the executives over at Chrysler. Interestingly enough, Elon Musk tweeting that he and Tesla were not actually invited to this event, Tom.
You're covering us a lot better than we are at 4 p.m. in the afternoon on the close. Let's have some obligatory CFA level 2 talk, Romain. Does the fundamental analysis really work, like indirect and direct cash flow, or are Ford and GM completely overwhelmed by the chip thing?
Well, right now, they're completely overwhelmed by it. I mean, you saw that in the monthly data that came out yesterday by 4 to 37% drop. You saw that in GM's earnings, which were also out yesterday, which showed a lot of pressure here on this with regards to their supply chain and getting the components they need. They can't keep up with demand, and as a result, that has actually seen demand fall. So it'll be interesting to see what the short-term effects of all this are. But there is a longer-term story here about these companies making cars, I guess, for a new generation of people who at least want the option to have something that's electric or hybrid or something else. Flip up the board real quick, just real quickly here. Later tonight, we are going to get a bunch of travel stocks reporting, including TripAdvisor and Expedia. Booking came out last night. They really knocked it out of the park. Those results coming in, the gross bookings at least coming in at about $22 billion, well above what the street was looking for at $16 billion. The CEO, Tom and John of Booking, Glenn Fogel, he'll be on with us in the 4 o'clock hour.
Romaine, thank you so much. The economic flow right now, folks, is extraordinary. As we spoke to David Blanchflower of Dartmouth moments ago, we are thrilled to bring you the former governor of the Federal Reserve System, Randall Krosner of the University of Chicago Booth School, holding court in London as well. Randy, we are staggering step by step through the tangible data through a new Fed policy. Dovetail the mystery around the table at the Eccles building. They have a new Fed theory, a new Fed construction, but we've got the same old data. How do they fit?
Yeah, same old data, but a new framework. That's exactly right. So we have this average inflation targeting framework that says rather than, well, when we see inflation coming, we're going to act now proactively. It says, no, we're not going to do that. We're going to wait until inflation gets to at least to our target or maybe even above before we start to act. And obviously, we've seen that because inflation has been very high over the last few months. But the Fed has said, hey, we're not moving until 2022, 2023.
Randy, are there any hawks left at the Federal Reserve?
Oh, yes. I think you see some of them.
Who are they? Because it sounds like to me there are doves and then there are super doves. Doves and super doves. And I see no hawks right now. Who are they?
Well, I guess that also changes in context, too. So you have someone like Governor Waller, who just spoke recently, who said, we got to get moving. We got to start tapering a little bit more rapidly because we see the economy coming back. Rich Clarida had a fairly optimistic view of where the economy was going, seemed to be discounting the role of the Delta variant, although he is certainly much more on the dovish side of waiting till end of 2022 before starting to raise rates.
Do you agree with Eddie Blanchflower, who was on the show earlier today, who is basically saying it's correct for all of these doves to be dove and dovish because basically the fact that we have this very low participation rate in the U.S. labor market is really a result of failed policy. Do you agree with that assessment?
I'm not so sure it's exactly a result of failed policy. I mean, I think there are a lot of people who've decided that, especially the older people who had come back into the labor market, who said, gosh, with all these uncertainties around health, maybe this is a good time for me to stay out of the labor market to retire. So I'm not quite sure that it's just policy. I think there are a lot of other things like the pandemic that is just a shock that we really can't do. I mean, we can respond with vaccines and such, right, but it just fundamentally changes the way people think about going to work, going shopping.
Professor Krosner, you represent the land of microeconomics. Macro is just more microeconomics at Chicago. Professor Krosner, how do you address the dynamics forward of our immense demand and supply imbalance?
So this is a really interesting question where policy has a very large role to play. Obviously, we've seen extraordinarily easy monetary policy and a commitment for that for a long time. Unbelievable fiscal policy, just unprecedented. You've heard that term a million times, but it really is true. We're either have spent or planning to spend on the order of 50% of GDP within an 18-month time period. That's just absolutely extraordinary. Plus, you had all the pent-up demand, the high savings that people had built up when they could go out, and so that's all being unleashed. And so, obviously, we're seeing that in terms of lots of price pressure, combined with some one-off factors like the chip shortage that you were talking about, like other supply chain disruptions. So we're going to see a lot of price increases in the short run. The key question is, are those transitory or are those sustained? I think we're going to see them transitory for a while. I don't think they're necessarily going to be sustained over the year to 2 year horizon, but over 6 months horizon, I think certainly.
Randy, I don't want to talk about projections. I want to talk about how we'd respond to outcomes. So help me understand this from a Federal Reserve perspective. if a high rate of inflation persists and it's primarily attributed to supply-side constraints, but those supply-side constraints also persist, how long before you have to take notice of that?
Yeah, that's a very important issue, because now it's sort of described as one-offs. There's some supply chain disruptions, but within 6 months to a year, they'll be eased. High demand for used cars. There are a lot of particular explanations each month. But if those accumulate over time, and in particular, if those start to change people's expectations, so that people are expecting that, well, gee, I need to get paid more in order to consume, and companies say, well, I can push price increases in a way that I haven't been able to do in a decade or two to accommodate those higher wage increases. You can get into this cycle where inflation starts to take off and become more permanent. That's really the key. Can they keep inflation expectations well anchored? We'll see.
Randy, got to leave it there. Randy Krosner, University of Chicago Booth School economics professor and former Fed governor. That's got to be the #1 issue right now, Tom. The supply-side constraints, if they don't ease going through the back end of this year, what does it mean for this Federal Reserve?
Well, there's just two different dynamics. And again, there's the macro view of the supply side, John, of the United States of America, but there's all the different subsectors. My optimism, a la David Kostin, is corporations, the large publicly traded ones, mid-sized, small business, on a microcosm basis, John, they will adjust sector to sector as they see fit.
And they are adjusting, and so far there is some real price tolerance in this economy. Lisa, to borrow some of the language from Chairman Powell, do these one-off increases, so-called one-off increases, start to shape the inflation process? Are we going to start to see that near a year end?
And how does this process get worked out with the fact that a lot of people have not gotten those wage increases yet? Do we start talking more about the S word, stagflation?
Stag-light. I thought that's what we're going with.
It's a Lisa we know and love.
Weren't we calling it stag-light, stagflation light?
Dr. Phil's working
something like
his
that.
magic.
Lisa's back. 6:30 a.m. Steve will be joining us. Steve Rasciuto,
Thank God the
Mizuho Securities
consultants
Chief
talked to her on the
U.S.
break.
economist.
Jesus.
Yields in a basis point to 117.36 on 10s.
That was
Equities
good, Lisa.
firmer up 0.2% on the S&P. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. Landlords have gone to court to challenge President Biden's extension of the coronavirus eviction moratorium. The Alabama Association of Realtors says the move goes against a ruling by the U.S. Supreme Court last month. The president had warned the extension could be challenged, and he urged lawmakers to come up with their own. New York Governor Andrew Cuomo is struggling to hang on to power. Cuomo stayed inside the executive mansion yesterday, a day after the state attorney general released a report outlining 11 cases of harassment towards women. Cuomo has denied that he will step down despite calls from former allies urging him to quit. And ExxonMobil reportedly is considering a major strategic shift. According to Dow Jones, the energy giant may pledge to reduce its net carbon emissions to zero by 2050. There's been no final decision. Exxon reportedly will unveil a series of moves on environmental and other issues before the end of the year. JP Morgan reportedly is pitching a Bitcoin fund to wealthy clients. According to CoinDesk, customers of JP Morgan Private Bank are being offered a passively managed fund in partnership with NYDIG. NYDIG is a Bitcoin-focused platform that's a subsidiary of Stonebridge, an alternative asset manager. CoinDesk says there are no investments from clients just yet. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning
Tesla beating across the board.
and who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
How do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
For the people here on Earth who are wondering why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
My concern is that over and over, he has weakened a regulation here. He has led the Fed to ease up there. He's led the Fed to help protect the biggest financial institutions. And there have been dissents against that. I am very concerned about that.
Senator Warren, with not exactly a ringing endorsement of Chairman Powell in an interview on Bloomberg TV and radio. From New York City this morning, good morning, with Tom Keene, Lisa Bravitz and Jonathan Ferro. This is Bloomberg Surveillance, and here's the price action. We're up 10 on the S&P. We advanced 0.2%. Mr. Costin over at Goldman, raising his price target to 4,700 year-end. Now looking for 4,700 year-end and 4,900 going into next year, year-end 2022. Into the bond market, yields are lower. 116 again on 10s, 116.86. Euro firmer, euro stronger, euro dollar 118.51. We advance on that currency pair by 0.12%, Tom, 118.51.
Interesting to see, John, what happens with claims here in 40-some minutes. To me, we've undersold it today. It'll be interesting.
We're looking for 383.
Yeah.
That's your estimate, Tom. Previous week, 400K.
Interesting to see. We're going to do two things here. We're going to get to Bitcoin here with Michael McGlone, really front and center with the worries about regulation. But first, David Wilson, looking at where I can capture a dividend. David, utilities and real estate, discuss.
Absolutely, Tom. I mean, you talk about interest rate sensitive stocks. Those two industries certainly qualify. They haven't been moving together lately, though, and it's something that Jonathan Krinsky over at Baycrest Partners pointed out. And if you look at the S&P 500 Utilities Index relative to its real estate counterpart, I mean, it peaked the ratio between the two in October. It's come down 25% through last month, and it's hovering near the low as we speak. And Krinsky's basically figuring it's time for a reversal. You know, in his view, I mean, the utility stocks look like they're, quote, ready for a breakout. And on the other hand, the real estate stocks, quote, are looking tired. I mean, that's what it comes down to. What's interesting with utilities, though, I mean, if you look back over the past few months, I mean, they were even falling when interest rates were falling, which doesn't necessarily make a whole lot of sense because they're the kind of shares that people tend to buy when, you know, they can't get all that much out of bonds.
For those of you on radio, just plain and simple, utilities are not what we looked at years and years and even decades ago. David Wilson, thank you so much. Too short this morning. Right now, we thought we'd parachute in Michael McGlone, truly expert on Bitcoin, including his latest junket down to Florida to see the Marlins. I think it was the Miami Marlins. You took in 3 games here. And this is on Bitcoin. And I'm sort of surprised at 38,000 Bitcoin, given the regulation ferment that's out there. Are you surprised at Bitcoin's resiliency as maybe we get to Gensler coin?
I love that. Well, Bitcoin is a discounted bull market is the way I look at it. It's probably put in a good base around that 30,000 level. It's got a good resistance around 40,000, but the new regulation time is very profound because the U.S. is basically embracing it with regulation. China's pushing back. I mean, banned it. To me, that's the new Cold War that's developing, and it's actually very good for Bitcoin. It's one thing that Gensler pointed out is Bitcoin's really not a security, so the U.S. is not going to do much to it. It's all the other issues, and the key things that aren't securities are digital dollars. So that's the key thing to remember is the most widely traded cryptos on the planet are digital versions of the dollar.
If Bitcoin is not a currency, I think we can agree it's not gold, and Gensler's saying it's not a security, then what is it?
It's like the best thing in the world for traders. Traders love it because it's not artificially stimulated. But the key thing is, I think the thing to remember is, it's gold becoming the digital reserve asset in a world that's going digital. It's major competition for gold. And even as Ray Dalio said this morning, it's a good portfolio diversifier. It fits very well in a bond portfolio, maybe just 5%.
Mike, how is it diversifying at a time when there's a slight risk-off tone with the Delta variant moving around? Is it acting like gold? Is it acting in a lack of correlation with risk assets?
Yeah, well, it is going to, if we get a 10% correction in the stock market, God help us, maybe someday that happens again. Bitcoin will probably go down initially, but like gold, look what bond yields are doing. Bond yields are already telling us that Bitcoin and gold have good value. They're stores of value. So I think what's going to happen here is Bitcoin, gold, and long bonds will be some of the best performers in 2H, most notably if the stock market just wobbles a little bit. And Bitcoin's already had its correction. Stock market hasn't. Crude oil is way too expensive, and the bond market's had its correction. Now it's going back to trend. Yields are heading lower.
Mike, one of the reasons why I love speaking with you is you can do new school and you can do old school. And when I look at old school, I'm looking at oil in particular. And the risk-off tone that we've seen in credit spreads, that we've seen in equities under the surface with the Russell 2000 has been seen also in the oil markets. Can you get a sense, based on positioning, based on fundamentals, of how much further this potential retracement has to go there?
WTI, $50 a barrel. It's not very profound. Number one, it's the 100-week moving average. Number two, it's the average price for basically the last 5 years. And guess what? The average cost of U.S. sales is around $35 a barrel.
Hold on a second. You're saying that it's going to go from 68 to 50, that's likely?
Yeah. That's, to me, is just that's where it belongs, to me. I mean, it's way too expensive above 75. And guess what? WTI, crude oil, has been an enduring bear market, and it's had a bounce in that bear market. So it's still at a premium in a bear market, the way I see it.
Right now, crude 68, Brent at 70. Good to catch up, Mike. Mike McGlone there, Bloomberg Intelligence commodity strategist. Lisa, surprised by that call, a move to the downside.
Well, I just think about how the fact that energy companies have outperformed pretty significantly. People have been piling into those shares. The possible bet as their recovery trade has been expected to gain steam. And we've heard from Bank of America about how they could see $100 a barrel to suddenly go back to $50 would be a pretty disruptive call.
What happened to that super cycle?
Right.
And all of those calls. You're right to point out some of the tension beneath the surface at the moment. Not a big crack in high yield this week, but something to keep an eye on. The underperformance of small caps is something we've been talking about for a number of months, but you saw that pretty profoundly in yesterday's session.
Yeah, I think it's notable just because typically people do look to the high-yield bond market for some sort of canary, some sort of forward look on risk assets. And what you've seen is a pretty steady widening in credit spreads to the widest since we've seen since May. Nothing catastrophic, still very tight. However, people are asking to be compensated more for the risk of default. This is new, John.
The Fed gave the canary a gas mask
Yeah.
over the last year, Tom. I'm not sure what kind of a read you can get from high yield in the same way you used to be able to.
I strongly support that. One of my themes this morning was the canary in Zurich, how Swiss 20-year, you know, John, it ebbs away, a greater negative statistic, but I'm not sure we know where the canaries are right now. And again, we're like the Fed, we're like Clarida, we're like Faro, we're all ex post, we're waiting for data.
We're waiting for new information too. Report from Reuters yesterday on the travel side of things that the US is developing a plan to require foreign visitors to be vaccinated, according to an official. Just seems like we might be lining things up.
What do you think about that, John, on
really
LHR to JFK?
It's slow. It's really slow and gradual, Tom. There is a hope this can happen. I think there's a window, though. It's kind of got to happen between now and October, the end of October, because when we start to think about the traditional flu season kicking in, Tom, you get deeper into winter.
Yeah.
Can you imagine an administration making a decision to reopen travel in a big way and say the end of November? That's difficult to get my head around at this point.
It's a scandal, John. I'm just trying to get to Chernobyl with Francine in early September.
I know there's some personal interest.
You know, this
here.
is just,
all round
sorry.
in different ways.
Yeah.
23% move lower, 24% move lower on the airlines, on the S&P 500 since April. It's been ugly. Your equity market looks like this. Up 10 on the S&P. We advanced 0.2% on the S&P 500. Yields in a basis point on 10s to 117.03. From New York City, heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
We've been waiting for vaccines. We've been waiting for the supply to pick up, and supply is exploding.
A pullback in yields could cause some of that volatility.
The Fed believes they have flexibility.
Our base case is that they tee up tapering perhaps as early as the November meeting.
In this world of great uncertainty, if you're pushed by what happens in 1 or 2 meters, you really haven't got the plot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A simulcast on radio, on television. We welcome all of you. We launch on this Thursday into 2 key days on the American labor economy. And, John, it really underscores the 2 Americas out there, the worry about jobs, the angst about 7 million employees. And David Kostin at Goldman Sachs, he goes long America this morning.
If you came into 21 bullish, you made a mistake, Tom. You weren't bullish enough. And Goldman Sachs were bullish, tremendously bullish. They weren't bullish enough. They had a 4,600 year-end price target for 22. It's now 4,700 for 21, and he's not alone. Many have built that gain through the year so far and capitulated to a higher view over the last week.
John, I'm going to frame it out to Ben Laidler, looking for an unprecedented 3 years of double-digit equity growth, and you wonder, what is the equity market signaling about the challenges of an economy? And to me, it's a part of America doing really, really well, but everyone else, not so much.
Earnings are solid. They've been tremendous. We've seen that over the last several weeks. Financial conditions are easy. Central banks. Look, Tom, in 2021, hawkish. Let's define what hawkish is in 2021. It's a central banker turning around and saying maybe the conditions are ripe now to scale back QE from 120 billion to maybe 100. That's hawkish these days. I think that tells you a lot.
I mean, Lisa, you look at where we are in the jobs report. We've got claims coming out here, Lisa, in 28 minutes off. What do you call it, Lisa? Soggy ADP report yesterday?
Highly disappointing, incredibly disappointing. Yeah. It was lower than the lowest estimate. So that was a disappointing jobs figure. Yes, we care, because these are all the countdowns to the Friday jobs report. I will just say that there is a question when you talk about the David Kostin call and you talk about the economy that still hasn't gained steam yet. How much are we bringing forward earning expectations? How much are we bringing forward growth expectations? And beyond this year, beyond next year, what kind of returns can we be looking at on equities and on bonds?
John, 383,000 claims. That's a lot better than a year ago, but still not 290 whatever.
870 on payrolls. And if we get a downside surprise, Tom, is it about insufficient demand in this economy? Most people are going to say no. They're going to say it's about supply and supply side constraints, and we need to see them ease, and September is the important month. How many times have we said that? It's a broken record now. September is the month.
I'm crushed, John. I just got a tweet in that I'm a broken record, so why don't you do the data check?
I'll get there right now, Tom. Your equity market higher, up 10, 11 points on the S&P 500, advancing 1/4%.
Nice
Yields taking a sneak peek at 112 in yesterday's session. Then a really hot ISM came through at around the same time that Vice Chair Clarida apparently was sounding hawkish. No idea what that's about. Yields in about a basis point to 117.03. Into the FX market, euro firmer, Tom. Euro dollar positive 0.14%. Euro dollar 118.54.
Let us stop. We need to stop the show. I said last night, and as we put the show together, I said stop. We need to talk to somebody and calm down about what to do into September, and for that matter, into September of 2022. Seema Shah is perfect with Principal Global Investors, their chief strategist today. Seema, can you own bonds?
Well, look, it's so challenging right now. I mean, 118, whatever it is now, it's very difficult to go long bonds at this kind of level. Now, look, of course, momentum can take you lower, but if we're looking at the fundamental story with strong growth, strong earnings, and a Fed, which, I agree, it's hardly, we can hardly call it hawkish, but ultimately they're moving to a point they're going to start normalizing. I think it's a really difficult argument to make to own treasuries.
Seema, global opportunities beckon. I've heard that a few times over the last few months. In fact, to be fair, I've heard it throughout the whole of this year. Why do they beckon now?
Well, I mean, look, there's a couple of reasons. You've got a global recovery in play. I think the most interesting part of this, though, is that you've seen it, a kind of a move from region to region to region through the progress of the vaccination. So we started with the US. Europe has had a fantastic couple of months. And to us, although EM is looking pretty dicey at the moment, there are still opportunities going forward. And then in this kind of environment where it's really difficult to make any decent return, you need to be looking at where's the next thing which hasn't yet been tapped for that vaccine progress.
I've heard it from US-based investors. They like the UK. The FTSE's up 10% this year. I'm told they like Japan. Japan's done nothing for me this year. It's up about 1% on the Nikkei. Do you like those markets too right now, Seema? Is there a reason to pivot away from the wonderfulness of the US equity market that we've seen through the year so far towards the UK, towards Japan?
Yeah, look, it's a really good question. I think, like you said, Japan has been such a disappointment. With the global recovery, typically Japan should do well. It just doesn't seem to perform. But we do think that there's opportunities there for vaccine progress, a kind of a jump start again in Japan. But, you know, I agree, it's difficult to stay excited about Japan. With the UK, I do wonder if they've had a bit of their heyday already over the last 6 months. We need to see more action from the government, more stimulus plans. What are they going to do from the fiscal side to keep this rally going? But certainly, you know, the US does look good. But there are always opportunities globally, and you know we know you need to be diversified, and there are other opportunities, Europe, EM, which is still beckoning for us.
Talking about the U.S., do you agree with David Kostin's view over at Goldman Sachs that we're looking at a 4,700 on the S&P at the end of the year and a 4,900 by year-end 2022?
So we are still very much risk on. We still think there's a lot to play for within equities, and for the same reasons that David's been pointing out, which is if you look at the fundamentals, earnings growth has been fantastic. You know, we're seeing companies showing real pricing power, which does fill us with some positivity going forward. I think the big question mark, as I said, is, of course, bond yields. And if we're going to get to that 2% level that some people are still pinning down for the end of the year, that's going to make it much more difficult. We don't think 2% is likely. It's a slightly lower level. And in that kind of environment, yes, US equities can continue to perform well.
Seema, can you walk us through a scenario in which bond yields get to 2% and the reaction function in equities? I mean, I'm personally confused by the scenario that will lead to 2% yields and then how that will trickle into equities.
Yeah, look, if put it like this, 2 months ago, if we'd then seen US yields hitting 2%, that would have been a steady rise through the rest of the year, and I think equities could have digested that. At this point, where yields are, for them to hit 2% now by the end of the year, that would be a very, very sharp move. It'd be very disruptive, and I don't think equities could cope with it. But to get us there, you need to have the growth boom really once again taking off. You need to have the Fed clearly indicating that tapering is on the agenda, and you just need that momentum to be there. Now, positioning to us tells us that it could shift, right? That momentum could come through where you get a huge overshooting of whatever your fair value perspective is. But we need a lot of the stars to align.
Seema, the challenge here is our history of EM is a history of 1992. I'm guessing Ecuador, Mexico came along in 94, and on and on. Is the great surprise out there that EM falls apart as the developed countries adjust over the next 24 months?
I think so. You know, I think a lot of investors, including us, we look at EM as a long-term opportunity. It's where your long-term growth forecasts are going to come through. And once, you know, we've got COVID behind us, especially for those countries, then we would expect a lot of those benefits to come through. So, but, you know, particularly with emerging markets, it's just not a homogenous market. You have to be picking your countries, your sectors very, very carefully because there is a lot of differences. And as we all know, politics becomes a far more important issue for EM.
Seema, we've got to leave it there. It's good to catch up. Appreciate your time. Seema Shah, Principal Global Investors, Chief Strategist out of London. What I'd like to do is frame where we were at the end of last year and give you a better picture of where these strategists thought we would go, where we are now, and where they think we're heading at the moment from here through to year end. At the end of last year, in the middle of December, we were coming off the back of an 11% gain on the S&P 500 through November. And many people thought we were pricing, perhaps too aggressively, this cyclical upturn off the back of vaccines which had tremendous efficacy. These were the forecasts, Tom. The most bullish forecast on the street in the middle of December into year end. 4,400 on JP Morgan, 4,300 at Goldman Sachs. And on that date in the middle of December, we were at 3,600 on the S&P.
Yeah,
yesterday we closed at 4,400 on the S&P. And I want you to remember how it felt in the middle of December when we heard those calls. Things like 4,300 at Goldman, things like 4,400 at JP Morgan, even things like 3,950 at Deutsche and 3,900 at Morgan Stanley. That sounded tremendously bullish when these forecasts were being put together. And this market has just ripped.
You walked through that nicely, John, and what's so important here is the cost and call is an extrapolation of the present trend. He's not talking about a level up. He's saying, I have faith in the present trend, and that's what the Brave Souls did last year. John, you mentioned the end of 2020. I'm still not over the Tots tied the Wolves then. I mean, that was a crushing.
The Tots and the Wolves.
They tied 1-1. It was
when
terrible.
Did that happen? Is that
end of
recent?
December. December last year.
You're going back to a game at the end of December.
I'm still not over this.
Last year. Why do you remember that?
Because they should have won, and they didn't.
That's your time.
The Wolves are always surprising.
Thank you, Tom. I appreciate that. Lisa, on this market, please, a comment, save us.
Well, we're talking about the upside surprises in earnings. We're talking about how the S&P has defied expectations in its march upward. And what I find fascinating is that you have seen earnings beat again and again in astronomical beats. Well, the economic data has been disappointing and has actually been some of the most disappointing in about a year. And John, I'm trying to square this idea, the fact that economists are actually overestimating, at least recently, some of the economic data, but they're underestimating corporate profitability and corporate growth.
Margins have held up. They've been able to pass on those higher costs. Top and bottom line growth. That's been the story, hasn't it? In a big, big way. And I just wonder whether those margins hold up. That's the key question, I think. That holds the key to performance going into the new year. Does the price pressure persist, and can the margins hold up? Your equity market right now up 11 on the S&P 500, up 0.25% on the S&P from New York City this morning. Good morning. This is Bloomberg.
With the First Vote News, I'm Rich Gupta. President Biden is laying out an ambitious goal today. He wants half of all vehicles sold in the U.S. to be emission-free by the end of the decade. Automakers say that can only be achieved with a bigger government investment in charging stations and other infrastructure. China's imposed new travel and movement restrictions in an attempt to stop the spread of the Delta variant. There have been more than 500 symptomatic cases so far. Public transport and taxi services were curtailed in 144 of the worst-hit areas nationwide. In Beijing, train service and subway usage were limited. And Moderna says its coronavirus vaccine remained effective through 6 months after the second shot. Concern that the effectiveness of the vaccinations could wane has led to talk of booster shots. Meanwhile, Moderna reported second quarter profit and revenue that beat estimates. Glencore says it could dramatically increase returns to shareholders going forward. The company is cashing in on the high prices for the commodities it mines and trades. Glencore announced almost $1.2 billion in dividends and share buybacks today. Surging metals prices drove first half earnings to a record. The Biden administration has approved its first arms sale to Taiwan. It calls for selling 40 self-propelled howitzers to the island, along with kits to add GPS to the shells the vehicles fire. The $750 million deal is almost certain to be denounced by China. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
What seems to be a really tough situation better than almost anyone else.
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance as well as, guide up for the rest of the year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I'd expect something between 2.5% and 3% in 2022. I think it's going to be more persistent. It is going to come down, but not as fast as what many people have in mind.
The president from the St. Louis Fed would like some optionality. That was Jim Bullard. We'll talk about that in a moment. From New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here is the Thursday morning price action. About 12 minutes away from initial jobless claims data in America. Equity futures up 11, advancing 0.25% on the S&P, inching back towards all-time highs on the S&P 500. Your bond market is unchanged. Yields going nowhere. 118.19 on a 10-year. As things stand, in the FX market, 118.48 on euro dollar. We're positive there, Tom, 0.09%.
Here's a real value add for Global Wall Street and for all of you on radio and TV. We're going to do this nicely. Stephen Rasciuto will join us here after the jobs report. Michael McKee with his massive value add as well, the claims report that we see today. And then before that, we get out front with Ben Emmons. He is with Medley Global Advisors and writes incredibly thoughtful pieces on central banks worldwide. To go from Emmons to Rasciuto is a joy. I'm going to cut to the chase. The great economist, John Farrow, said a while back, are there any hawks left? Ben Emmons, are there any hawks left?
I think they are, Tom. I mean, I think maybe James Bullard is one of them now, even though he was considered to be dove. I guess the word hawk is about, risk management, right? They are looking at inflation above target. They think it's transitory, but they don't want to take a full chance on it, that it stays stickier there. So there's some level of hawkishness or hawkier Fed there. On the other hand, you're dealing with a Delta variant that can affect the economy again. And so you cannot be traditional hawk, right? You got to be more flexible.
How does the theory you write about that our listeners and our viewers angst about big time, how does that theory fold over into market reaction?
I think the market at the moment is taking the Fed on its word that you are dealing with an inflation that could moderate over time, so that results in a flatter yield curve. But you can't go that flat that you're in an economy which is still above the growth trend, right? That would be strange to have a yield curve becoming closer to maybe inversion. So I think the market is set like Fed can normalize somewhat against the backdrop that inflation indeed is not as transitory as it may seem, but at least not as sticky either. So I think the market has a good vision on the Fed from here.
Ben, going forward to tomorrow, we're going to get that labor market report, the jobs report. How will the market respond to an upside surprise?
It's interesting, Lisa, that the dispersion in that labor report is 1.2 million to 350,000, right? So they have this huge difference of expectations. So if you think of upside surprise, we would be much closer to that 1.2 million to, I think, really get a reaction in the market against the downside, which is maybe more sensitive. You know, the ADP number yesterday wasn't, I think, a downside surprise that it maybe make people wary of, like, where are we exactly with jobs, considering that people have been bullish on the economy. So I'd say there's more downside surprise sensitivity than the upside, given that upside looks like 1.2 million expectations.
But Ben, we've been talking a lot on this show about how when there is a downside surprise, perhaps in the economic data, the reaction in assets is not necessarily what you would think. And you would see that same thing with an upside surprise, that basically if you see a stronger labor market, that means that the Fed may taper sooner. What's the sort of bleed through effect into markets? Does it mean bond yields in the longer end are higher or actually lower because there's going to be a sooner taper?
You would think more like lower rather than higher, because if you do lean against a strong jobs report with the sooner taper, as you mentioned, then it leads again to more flattening of the yield curve, you know, because you're trying to control the effect from a stronger accelerating job report already into a inflation rate that's above the target and maybe more persistent than transitory. So I think you get a curve flattening if you get a stronger report.
Ben, all this mumbo jumbo's about America's doing it different. In Europe, we're enjoying negative interest rates to beat the band. Here we've got a negative real rate as well. The angst here for everyone is we're at the zero bound. And the fear of the hawks is we got to get off the zero bound so we got some powder dry for the next recession. How valid is that wish?
It's a challenging one, Tom, because I think what has shown this episode again, how quickly we hit back to the zero bound as we get a shock, that getting off zero is really complicated.
But that's about price, not yield. That's about people, this insatiable wall of money pushing up bills, notes, and bonds. Is this the Fed's fault that they provided massive liquidity with fiscal policy and they're at the zero bound for edge of forever?
I think it's a side effect from that policy indeed, because this balance that the Treasury had at the Fed is all trickled into the system this year and has actually contributed indeed to lower rates, not higher rates, which you would otherwise consider given where the economy is. So yes, this zero bound is a difficult situation, and to normalize from that will take, I think, years to actually do that. Think about, too, if we're going towards the decision on tapering, we're going to have to think about the balance sheet, right, which is another issue that could have a major effect.
Ben, thank you. John, this is the heart of what you've talked about from days when you were covering the ECB when you were 17 years old. The bottom line here, John, is Europe's done it different. Which is better, John Farrow? Negative rates in Europe or angst of the zero bound?
Europe's got stuck. Japan's got stuck. And there is a conversation now. It's not a base case, but a conversation now as to whether the Federal Reserve will get stuck as well. I've said there are no hawks at the Federal Reserve. I understand everything's relative, but here's one of the more hawkish policymakers at the FOMC right now on the Federal Reserve, to be more specific, President Kaplan. Here's the quote. I think we'd be better off to start adjusting these purchases soon, but my comments on purchases are not intended to suggest I want to take more aggressive action on the Fed funds rate. This is about tapering QE from 120 billion, Tom, every single month. Is that hawkish these days? Is that what we think is hawkish in 2021? Because let me tell you, if it is, it's going to take a long, long time to, one, unwind that thing, and two, have a real conversation about raising interest rates.
Secretary Geithner said a long time ago, John, it will take a long, long time, but you got to start the process at some point. When do we start the path to some form of normality, as Mr. Emmons mentioned?
The issue that they have, and it's a big one, and President Kaplan has just alluded to that in that comment, they want to aggressively de-link the conversation about tapering from the conversation about rates.
Fair.
Whether the market sees it that way in the coming months will be very interesting because, as you know, Tom, it will be about the next stage in the sequencing for market participants. The next question after they started tapering will be, okay, what about rates?
Did I do okay with Ben Emmons there?
You were great.
Was that, you know,
it's good to see
I was
Ben.
trying
Nice to
to,
have him in the studio. Ben Emmons.
It was like a
of
bow
Medley
tie
Global Advisors,
conversation.
Global Macro Strategy Director in a tie, Tom.
Yeah.
Not in a bow
He's
tie.
going to wear a bow tie next time.
Steve
so
Raschuda,
we'll
mate.
share a tie.
He'll be joining us next from Mizuho, the chief U.S. economist, coming up just around a corner. Following jobless claims in America, we'll catch up with Michael McKee on that as well as we rattle through the price action in the equity market. On the S&P 500, up 10, 11 points. We advanced by about 0.25%. Really, really stable, muted price action in the bond market. Yields at 118.03. Yields going nowhere this morning.
John, the VIX is 17.63.
118.42. We're positive there, 0.04%. It's calm, Tom. It's pretty calm as well, all things considered.
Seriously, yes.
Waking up this morning to the news in China that restrictions are building again, and here we are, just kind of floating through this. So far, so good. Lisa, big question, can we keep climbing this wall of worry?
And honestly, the answer has been yes. Going forward, a lot of people think that the answer will still be yes.
So far, up 0.25% on the S&P. Your initial jobless claims in America coming up next from New York, on radio, on TV. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance, and more.
2022年完成空间站的在轨建造，建成国家太空间之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station.
出发，是，敬礼。
China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Global markets never sleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Jobless claims data 10 seconds away in the United States of America. Live from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Your equity market shaping up as follows on the S&P 500. Advancing 11 points, up about 0.25% in the bond market. Yields unchanged at 118.03. And jobless claims hitting the wires. Here's Mike McKee with more.
Well, we're just getting the numbers here, John, and for once they come in pretty much as forecast, 385,000. That's down from 400,000 the prior week. Actually, we'll look there. It was revised up to 424,000. So initial jobless claims, a significant drop from where they were. The forecast was for 383,000. So we're just about bang on there. Now, the interesting news here in the 385,000 may be good news, but tomorrow's jobs day, so people will forget about that. Other than the trend is good, is we're watching the total number of people who got the benefits, any kind of benefits, 13,156,000. And so at that point, let me just double check these numbers here. Actually, we're a little off here, but because the numbers that they send out were slow. We have 12,975,000. I apologize for that, but that is for the week of the job survey in July. So we saw a big drop in the total number of people collecting benefits. Doesn't necessarily mean they all got jobs, but it does mean they're moving. The labor force flow is moving in that direction to at least in the labor force from no longer collecting benefits.
So, Mike, let me rattle through the price action. I'll come back to you on some of this data in just a moment. Not much price action to speak of. Your equity market was slightly elevated. It stays that way, up 0.25% on the S&P 500, advancing 10 points. The curve was a little flatter, driven by what's happening at the front end. Yield still higher by a basis point on a 2-year, basically unchanged on a 10-year at about 118, 119, sub 120. Outside of that, in foreign exchange, it's been stable and unchanged through most of this morning on euro dollar, in and around 118 or so. Mike, when you put it all together, if you take the jobless claims we've just seen, the ISM services read we got yesterday, which was really quite tremendous. Walk me through the expectations now. Tee us up for Friday and throw in that soft ADP read in the mix if that counts for anything at all.
Well, that's the question. Does it count for anything at all? ADP has gotten the direction right, but not the magnitude for months and months now. Can't really blame them. Economists have had a tough time too, but we're forecasting 870,000 jobs created with a very wide dispersion from 350,000 at the low end to 1.2 million at the high end. So economists really struggling with this. We're looking for 28,000 jobs created in manufacturing. That comes after the better news from the ISM manufacturing index. The question will be how many service jobs do we get? That's the big one, and we did see a significant rise in the services numbers. And then labor force participation, 61.8%, expected to tick up from 61.6%. That would be good news, although there's still a lot of pessimism about how many people can be brought back in because of all the retirees.
Mike, we're enjoying a conversation with Ben Emmons, on to you, and then on to the great Steve Rashuda. Let me ask you one question, because you're in the room with Chairman Powell when the heat's on and he's getting grilled with your questions. Do you partition Fed analysis from QE and separate rate dynamics, or do you mush them all together?
I think you partition them at this point because the Fed can start cutting back on QE and it won't be tightening. It'll be just less stimulus. Whereas when they start raising rates, they start to tighten financial conditions, and that will have a bigger effect on the economy. And I know you're going to talk to Steve about that. But at this point, look at them separately. Quickly mention that the trade deficit came in wider than expected. Negative $75.7 billion. The forecast was for 74.2.
Remember when 50 was normal?
That is a huge number. I can quickly check here whether it's a record or not, but it does suggest that it does look like it is the most since it may be a record. Maybe a record. At this point.
I mean, this goes back to Lincoln or even back to Andrew Jackson, right?
Well, Yeah, although the economy keeps getting big, it was a little bigger than it was in Andrew Jackson.
It's real simple. John, Lisa, and I, folks, get to do all of this truly ex post. Like we see the data, we get to massage it. McKee's got to do it in real time, which is a real art. John, that issue, you brought this up, John. I'm going to give you credit for this. The partition here between flow dynamics and new theory of QE and worrying about Arthur Burns' smoke signals or Greenspan's ham sandwich. I mean, it's a changed discussion.
But we used to talk about rates. That's what we used to talk about. That was the first lever, the only lever to pull on.
The only lever.
Now we're talking about QE.
Lever is like lever, folks.
What's more important, QE or rates? Let's bring in Steve Raschuta for more on that from Mizuho Securities, the chief U.S. economist. Steve, let's start there. You think that QE is actually the more important tool here? When someone like myself sits here and says, you know what, I think QE doesn't really matter. 120 billion, 180, that doesn't make a difference. You think it does make a difference, Steve? Why?
I do think it does, because I believe, you're living in a world of excess supply, and therefore what you need to do is you need to create the liquidity that allows inflation rate to actually not get sucked into a deflationary bias. And this has been the Fed's ongoing risk by continuing to fall back into their preemptive ways. And this is the thing that worries me the most. The interest rate dynamic, how it affects the currency, is not having any impact whatsoever on the currency. A difference between a near zero interest rate level or a 5 to 10 basis point negative isn't going to cause people to move assets around globally and therefore affect the currency and then expose us global import prices. But QE does. QE1 worked very, very well at avoiding the deflation initially during the financial crisis. QE2 worked very, very well to do exactly the same thing. And it worked very, very well in here until the Fed began the process of backing away from being preemptive, backing away from being reactive to being preemptive by laying out forecasts of when they thought it would be appropriate to exit QE. I don't think they should ever exit QE. I think they have to trim it back to the pace of nominal GDP growth and leave it an automatic pilot.
This is a huge call. They should never exit QE. And the follow-on here is they should never shrink their balance sheet. The idea here that an $8.2 trillion Fed balance sheet is not big enough. How big should it be, Steve?
Well, I don't think there's an answer as to how big it should be. Let's take a look. 5.4 trillion, the big expansion here, was done under the environment of offsetting the huge drag on the economy as a result of the COVID-19 lockdown mitigation strategy. That is a one-time permanent increase in the balance sheet. Allowing the balance sheet to then continue to grow at the pace of nominal GDP suggests primarily that you're continuing to support the economy. You want that level of nominal GDP to be consistent with, let's say, a 5% nominal GDP growth, so you can get a growth rate that's somewhere between 2.5% and an inflation of 2 to 2.5%. And therefore, it gives you an environment where you're supporting that inflationary bias in the economy to avoid the bigger risk of falling into deflation, which Japan has been in for 30 years. Europe is arguably in there now with 30-year bonds trading in the negative territory, 10-year bonds down at minus 50. Europe has gone down the deflation path. There's arguments that China's gone down the deflation path or is going down the deflation path. That's 38% of global GDP. They're all net creditors. We're a net debtor. If we have deflation, it's a real problem.
Steve Raschuta, have you extended out this glide path from a boom economy back to some form of normal? Have you, in the last weeks, even the months, extended that out into 22, 23, and indeed even 24?
Well, I mean, you have. I mean, the reality is the stimulus that we're providing is transfer payment. And to a great extent, it has been a one-time transfer of wealth because households have been allowed to deleverage, which is good, increase their savings, which is good. So we've taken wealth from the public sector and we've given it to the private sector. That's good. That assures you a longer sustained expansionary environment. But it doesn't tell you the rate of growth that you're going to get. And I think in a global deflationary world where we have a trade deficit of $75.7 billion, where basically we've leaked a lot of the stimulus transfer payments, the demand that was created overseas, and yet they still can't get out of a deflationary bias. We're in an environment where we're going to rapidly turn back to that 2 to 2.25% growth rate. And our forecasts are we get there by 2023.
Steve, just quickly, payrolls tomorrow, 870 the estimate. What are you looking for?
Well, I'm slightly below that. I'm in the 750 area. The reason for it is, look, either one of those numbers is great. I just think the seasonal factors are probably a little bit screwed up given the volatility last year. And again, I don't know how many of the seasonal workers relating to education, because a lot of the southern schools have already gone back to the classroom, whether or not that manifests itself, especially in the Northeast area where people are being a little bit more reluctant to start bringing people back, not knowing what's going to happen as we go into the September school year.
Steve, got to catch up to get your thoughts, especially going into tomorrow. Steve Rasciuto of Mizuho there, looking for 870. That's your median estimate. The range is wide, wide, wide. It is always wide, wide, wide these days. Lisa, 1.2 million all the way down to 350K.
I just have to go back to what Steve was just talking about, that despite those numbers, that the Fed should not exit QE. When you talk about an exit strategy over at the ECB, he doesn't think there should be an exit strategy here in the United States. And the implications of that are pretty significant.
Fed coverage can get emotional. People can become obsessed, consumed by what they think the Fed should do. Thomas, about what the Fed will do. That's what matters here. We spend way too much time about the should. Need to focus on the will. What will they do?
Yeah, that's the Georgia School, and Professor Timberlake, who I was honored to meet, very elderly at the time. And of course, this is the huge influence, as you mentioned, Mr. Kaplan earlier, John, and the Dallas Fed. Don't look about the theory. Don't look at the parlor game. We try to avoid that on surveillance, John, and just look at what they're doing, they're saying, and maybe what they'll do off of real data.
Coming up on the Open, we'll be catching up with Krishna Mamani of Lafayette College, the CIO. Looking forward to that conversation as we count you down to Payrolls Friday on Bloomberg TV, on Bloomberg Radio for our audience worldwide, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market up 9 points, advancing 0.2%. Your bond market unchanged on 10s, 118.36. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. Landlords have gone to court to challenge President Biden's extension of the coronavirus eviction moratorium. The Alabama Association of Realtors says the move goes against a ruling by the U.S. Supreme Court last month. The president had warned the extension could be challenged, and he urged lawmakers to come up with their own. New York Governor Andrew Cuomo is struggling to hang on to power. Cuomo stayed inside the executive mansion yesterday, a day after the state attorney general released a report outlining 11 cases of harassment towards women. Cuomo has denied that he will step down, despite calls from former allies urging him to quit. ExxonMobil reportedly is considering a major strategic shift. According to Dow Jones, the energy giant may pledge to reduce its net carbon emissions to zero by 2050. There's been no final decision. Exxon reportedly will unveil a series of moves on environmental and other issues before the end of the year. And Penn National Gaming is moving to expand in the fast-growing North American sports betting market. The owner of Barstool Sports has agreed to buy Canada's Score Media and Gaming for about $2 billion in cash and stock. Score is the top sports app in Canada and number 3 in North America. In China, TikTok owner ByteDance has laid off hundreds of employees. The social giant is shutting down a significant part of its online education business to comply with Beijing's new regulatory regime. Those curbs on the after-school tutoring industry include a ban on profits. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
week on Bloomberg Green, cutting carbon out of travel. Trains, planes, and automobiles. How Europe's lawmakers are pushing travelers to ditch the short-haul flights.
There's a huge potential to shift from air to rail, and that must be supported politically.
Making jet fuel out of chip fat. We speak to the CEO of Neste about the company's plan to clean up aviation.
It has a lower emission alternative, to conventional fossil jet fuel that is enabling the aviation sector to also significantly reduce its climate impact.
And Elon Musk's fabled fifth mode of transport may soon become a reality. But just how close are we to building a Hyperloop?
Some brilliant engineers have spent real time grinding out the details, and I thoroughly expect the next 3 to 5 years to be decisive.
Catch this week's episode on Bloomberg TV, Quick Take, and online.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
There are a limited, very limited number of countries that have begun to administer third doses, which we would call booster doses. The evidence is evolving, it's moving. We don't have a full set of evidence around whether this is needed or not.
Day by day, a movable story. Catherine O'Brien, she's with the World Health Organization, addressing the fears, the sum of all our fears, as so many others are. We spoke earlier with a protein chemist from Johns Hopkins. I thought that was very informative. Now, Lisa Bramwitz and Tom Keene with a really, really important discussion on a concept I totally disagree with, which is herd immunity. Sam Fazeli, Dr. Fazeli, with Bloomberg Intelligence on pharmacology, wrote a tour de force yesterday on herd immunity. Sam Fazeli, is herd immunity a valid concept, or is it a theoretical out there that we will never get to?
Hi, Tom. Thanks very much for having me back on. It is a calculation that can be made on paper using the X number of variables that tell you what you think you're going to need to try and stop the chain of transmission of a virus. But while you're doing that, the virus is changing, the people are changing, the world is changing, so it's not easy.
Is it a concept from microbiology and bacteriology that is really less efficacious with virology?
I don't know if I can generalize like that, Tom, but certainly with viruses who have a much higher ability to mutate and evolve depending on the virus, right? And also, you make all your predictions based on what you think you know about the virus. 6 months ago, when we were talking, Tom, we were saying the virus doesn't change very much. But here we are with, I don't know how many variants now we've got, right? So that's where the problems arise.
What did you make, Sam, of Moderna's intelligence earlier today, saying that that their vaccine was 93% effective 6 months after the second shot?
Yeah, I think that's wonderful. But don't forget the little detail. The data was cut on the 26th of March. So it really, again, like the same what we've just been saying, it doesn't have much read-through for what's going on the ground now. I would be surprised if the vaccine is significantly more effective in against Delta than the Pfizer-BioNTech vaccine.
So can you give us a sense of how important it is for the vaccines to prevent infection and prevent transmission of the virus versus hospitalizations and deaths? I mean, whenever we talk to health officials, when we talk about how effective some of these vaccines are, they say, look, it prevents death really well. And yet you've got others saying, well, wear a mask if you're vaccinated at home if you've got children that are unvaccinated. Can you give us a sense of the importance here on breakthrough infection?
Yeah, Lisa, so that's an incredibly important point. For me, the job of the vaccine is to stop me getting disease. Whether I get a bit of virus in my nose that makes me sneeze and cough and have a runny nose is to a degree irrelevant. The problem for the community is that if I am then infected, then I raise the risk of people around me getting infected. So breakthrough infections are relevant if we want to stop the virus. But certainly the vaccination is for really protecting us from disease, severe disease, hospitalization.
Sam, let's go to your wheelhouse. Dr. Breyer at Johns Hopkins, truly a world-leading epidemiologist, was heated the other day with us that we need to focus on mRNA, the winning vaccines that get it done. Is that the only path we really have, Sam, is just to solve it in the developed countries, move to the second-tier countries, move to the third-tier countries? Is that the way we're going to do this?
Yeah, Tom, as it stands, the data is best for the mRNA vaccines, including the safety angle. The question that we have to address, though, is it possible that the non-mRNA vaccines, such as Johnson & Johnson and AstraZeneca, may be giving us a slightly broader response? And that's a complex conversation. But as the data stands, I agree with what he said.
Sam, this is a touchy question, and that is profitability for these vaccines for the likes of Moderna and Pfizer. How profitable have they been?
Well, I mean, for Pfizer, we saw the numbers that they're talking about, $33.5 billion of sales this year, and, you know, having probably something in the region of a 20-25% margin in the end, because they share that revenue with somebody else. The point is, well, we know roughly what the cost is, right? Because they did this deal with the U.S. Army for 500 million doses to go elsewhere. That comes at about $7 per dose. So that's the cost. The point is, I mean, I don't begrudge them at all. They took an enormous risk with these vaccines that nobody thought would be anywhere near as good as what they are, never tested before. And now what are we saying? They're the best out there. Who could have done this apart from a large, highly focused pharma company?
Sam Fazeli, thank you so much. Congratulations on a world-class note on herd immunity. We'll get that out on Bloomberg Opinion. Lisa, we're supposed to wax philosophical here, talk about claims, get to the jobs report tomorrow, but I want to rip it up because August is moving forward, Lisa. We're beginning to get the summer reading list angst to really click in. We're going back to 2 + 2 = 4, you know, getting the math going. And Lisa, it's like school time again. It is now back to school.
Well, you're talking specifically about the Abrama the Abrama household, right? Basically, my kids are going back to school. But it really does raise a question for most kids. There is this countdown to the initial day of going back with masks on, with masks off. This is all up in the air. How people are going to get back to school, though, is becoming a market issue, which I find fascinating, Tom.
It's a market issue, and again, we go to the heartland of the South, where they start school much earlier than we do in the urban East. And Lisa, you know, August 20 is like tomorrow. And then we get the sports teams. Lisa, remember in high school, some people played sports and they came back
Soccer
a few
team.
weeks early.
Oh yeah, I remember that.
Oh yeah.
Yeah.
But you come back and, I mean, we're there as far as I'm concerned. I'm back to school.
So what do you think about the market response to if there is a return to remote schooling? I mean, we were just talking earlier today. Yeah, I think that this is really interesting. We were talking, Gene Tenuzzo said that he could see 10-year yields going below 1% if kids are not allowed to go back to school. I guess that people will be that depressed. They'll just pile into bonds and drink away their sorrows. I mean, at a certain point, you have to get life back up and running.
Along this line, folks, Moderna out moments ago. We bring this to you across the Bloomberg terminal. The third dose may be needed in the northern hemisphere this winter.
Interesting.
Ongoing debate that we will see. And, for someone that grew up on booster shots like all of us, Lisa, I'm like, well, okay,
yeah.
You need a booster shot.
Can I point something out? One thing that we kind of glossed over because the jobless claims data came out, and that's very much in front and center because of the emphasis by the Federal Reserve. But the trade deficit rose to a record or fell to a record, depending on how you look at it in the United States. This idea that we have so much demand that we've been importing more and more and we haven't been exporting as much. I think that that's significant, especially in light of some of the trade issues that have come up over the recent years that don't seem to be in effect in any way.
I think you're correct, is how I'd put it. I will look at the twin deficits, the trade deficit to GDP, the fiscal deficit to GDP, and that's original math. Those are two trends a gentleman from South Dakota knows. Senator Michael Rounds, the Republican from South Dakota, very aware of our trade dynamics. That's a conversation at the 12 o'clock hour. Tomorrow, Jobs Day. Stay with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City for our audience worldwide. Good morning, good morning. Equity futures positive 0.2%, 30 minutes away from the opening bout. A countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
From New York, we begin with the big issue. Can we keep climbing the wall of worry?
There's been a lot of concern, speculation, hope perhaps. The big scare on the Delta variant.
The Fed reaction function.
Inflation being a little bit more persistent.
The labor market outlook.
It's signaling in terms of tapering.
The supply chain challenges.
There's a lot of concern about demand slowing.
Peak everything. It's peak growth, peak earnings, peak monetary policy.
There is generally some caution in the economy.
But we do think that risk assets in developed markets will likely continue to outperform
when it comes to prospects for risk assets.
We just came out of a very strong 2Q earnings.
We're still very bullish.
3Q looks like it's setting up to be pretty strong as well.
The market has a lot of room to run.
Good news might be a little bit of bad news at this point.
Joining us now, the panel, Morgan Stanley's Lisa Shallett, Clear Harbour's Aaron Cannon, and Krishna Mamani of Lafayette College. Lisa, I want to start with you. There's so much to worry about on any given morning. Can we keep climbing that wall of worry?
Well, look, our perspective is certainly we've had a series of catalysts, not the least of which has been spectacular corporate earnings. But I think that underneath the surface, we're going to really start taking apart what comes next. And from our perspective, that what comes next is that, in fact, some of these corporates, the expectations have just gotten ahead of what we ultimately think is going to be achievable. We're going to start seeing some margin pressure here, whether it's from input costs and supply chain impediments or rising wage costs and labor. I think one of the stories that's not being told is that a good third of companies that have reported have either rejected giving forward guidance or given negative forward guidance. And that really says to us that these earnings revisions, which have powered this market, are poised to roll over. And that's really the pause and the 10 to 15% correction that we see coming.
This is the deceleration theme. Aaron Cannon, you and I talked about this recently. Let's talk about it again. Deceleration. How does the market function in the face of that?
Well, it's interesting, Jonathan. What we've seen, too, in the midst of this lower bond market yield environment, which is very much a forward-looking indicator on the deceleration trend, is the conundrum that the Fed faces. Yes, decelerating growth, but also, the sort of persistence of inflation. And in the midst of 7 million people today that are unemployed relative to pre-COVID. And so you have a monetary conundrum. As it pertains to the market, I think we're already seeing the deceleration expectations in place. We're seeing that rotation. June 15th, energy was up for the S&P 500. The energy equities basket was up about 50%. Now it's only up 28%. That's a rather significant move. Those rotations in other cyclical areas like industrials, as well as banks, have also been quite noticeable. On the other hand, in an environment where growth starts to really become a diminishing, decelerating factor, you would expect areas like healthcare and technology to outperform. And that's exactly what we've seen since that June 15th peak in energy.
The index, though, is doing okay, and Goldman thinks the index will continue to do okay. They raised their price target, Mr. Costin and the team this morning, to 4,700 on the S&P 500 from 4,300. They say the following: we expect earnings growth will be the primary driver of U.S. equity returns in the second half of 21 and 22. Lower than expected interest rates support a stable forward PE multiple of 22 times. Krishna, I want to bring you in. 4,700 year-end at Goldman. 4,922 year-end at Goldman. Krishna, does this market keep on climbing?
I think so. I think if you kind of simplify things, the economic momentum, even with deceleration, is still substantial. And in that sort of environment, with continued earnings increase in expectations with respect to future earnings, low interest rates, high liquidity, this sort of an environment is very hard to take the market down, especially when people are still feeling good. Clearly, a monetary policy surprise or a severe case in Delta or something like that could definitely put a bit of an issue in the market. But I think at the end of the day, the economic momentum, earnings momentum is enough to carry the market.
China, Delta. Krishna, there's always something to worry about. China and Delta, the latest this morning. I was surprised to see the market firmer off the back of the world's second largest economy imposing a fresh round of travel restrictions, limiting taxi service, train and subway usage throughout Beijing. Let's get more on this with Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, it isn't just Beijing. These restrictions are wide-ranging. Taxis, subways being restricted in 144 of the areas hardest hit by the most recent surge in COVID cases in China. That is now hundreds of cases spread around half the country. And now authorities are warning people not to travel. Colleges are asking students to delay their return to school. And even beyond China, you have Melbourne extending restrictions, Southeast Asia tightening measures as well as they deal with a rising case count. And of course, here in the U.S., the case count is going up as well. And as a result, we are seeing mask mandates put into place. But even with the number of cases going up, there may be some solace in the fact that the mortality rate has stayed low. In the second quarter of 2020, of course, the death rate as a percentage of cases reported was over 5%. In the second quarter of this year, it's just 1.95%. It's been holding in that 2% range really over the last year. And part of that is the understanding of how to treat the virus better. And a big part of that also is vaccinations, because inoculated people who test positive are highly unlikely to get severely ill or die from it. And even though the science says that, John, the question is, will consumers still change their behavior because they fear testing positive again? That, of course, creates a real growth concern. And for this market, it creates concern around some of those reopening trades. We had seen the stay-at-home stocks falling out of favor. Instead, investors flooding toward reopening trades like travel and hotels. That has reversed over the last month and a half, John.
Kelly, thank you. Thank you very much. Waking up to more concern about China and the Chinese economy. You look to the FX market, the Aussie dollar is stronger, top of the pile, the Aussie stronger by 1/3 of 1%. You look to dollar China, that's been stable throughout the whole year, 646, 647 has been the average. That's where we are right now. And you bring up the commodity screen, I would go straight to copper. Copper over in London right now is stronger by about 1/10 of 1%, higher by 0.13% on the session. Lisa Shallett, if I was concerned about China and Chinese growth, you'd expect something to be happening there, wouldn't you?
Yes, absolutely. And, you know, this is one of the things that we've been pointing out to clients and, you know, why we've been trying to encourage them to take advantage of the value in some of the more cyclical parts of the market. And that is because the commodities complex and the industrial metals in particular are not at all signaling this slowing of growth. And while, you know, the Delta variant, as always, comes with a human cost. This time around, we really believe that global economies are going to attempt to power through. Now, we have to recognize that places like China have taken a zero tolerance approach. And so they are going to continue to have a heavy hand and introduce lockdowns. But it's our anticipation that those lockdowns in China are going to be offset by even more stimulus, both monetary and fiscal spending, that allows their growth to stabilize and in fact, maybe even rebound in the second half of this calendar year.
Let's build on that, Lisa. Krishna, your thoughts on this? You can look at the policy change, the new restrictions in China as a reason to worry, or you can look at the course correction and say this will lead to a more sustainable recovery in the reopening parts, the more cyclical parts of this market further down the road. Do you think there is an opportunity to get back into the airlines, to get back into energy with the correction we've seen over the last few days?
Well, so that sort of depends on what your investment horizon is. I think if you are looking to 2022, overall growth is going to slow down. So in that sort of a context, cyclical part of the market doing extraordinarily well, to me, it seems quite unlikely. I think what is more likely to happen is the fact that companies that can deliver superior growth in a low growth environment and have really fat margins. Those are the parts of the markets that will do very well. There might be an uptrade in the near term, but I don't think that would be sustainable. It's still going to be 2% growth in 2022. And in that environment, it's really more about high growth companies rather than cyclicals.
I'll get to that 2 and 2 call for 22 in just a moment, Krishna. Erin Cannon, your reaction to this, the opportunity that may or may not be there in a cyclical part of this market.
Yeah, I think it's challenging to be extraordinarily bullish on parts of the cyclical market. I mean, certainly, would you rather bet on oil at 55 or 75 here? I think there's probably a thesis for 55 over 75 on a risk-reward basis. I think some of the industrials are coming in showing very nice growth. There's a lot of opportunity there. The aerospace industry will be coming back, part of defense, and part of the sort of less cyclical components of industrials look quite interesting to us. But we do think, to Krishna's point, in a lower growth environment, 1 year, 2 year, 3 years out, we start to see trend growth again. You want to focus on the growth companies, the technology companies, the consumer discretionary companies, the asset-light companies that are expanding their earnings, top and bottom line, on a go-forward basis. We think that will be where the moats really reside in a year or two from now.
10 minutes into this show, and we've hardly talked about the Fed. That's good. Let's do it now. Fed Vice Chair Rich Clarida saying his forecast should position the Fed for a 23 rate hike. Take a listen.
If the outlook for inflation and outlook for unemployment I summarized earlier turn out to be the actual outcomes for inflation and unemployment realized over the forecast horizon, then I do believe that these three necessary conditions for raising the target range for the funds rate will have been met by year-end 2022.
Let's bring in Michael McKee. Mike, if the forecast becomes the outcome, this is what I will do. Not exactly earth-shattering stuff, is it?
Especially from a guy who may not be on the Fed in 2020.
Well, that's a good point, too.
His term is coming to an end. We don't know if he'll be reappointed. But what is interesting is that Richard Clarida said the same thing as Christopher Waller, the Fed governor, who suggested that they want to see more improvement in the labor market over the next couple of months. And, well, we get a labor market report on Friday. The latest numbers, this is jobless claims today fall to 385,000. But the graph you're looking at is total claims being paid, and it's 2 weeks lagged, but it now encompasses the week they took the July payroll survey. And that is 1.2 million jobless claims fewer than in the week of the June survey. So there's a possibility we see some strong job growth. A lot of debate about what's going to come up tomorrow. Now, what is the Fed thinking? Here's a chart I took from the good folks at Bloomberg Economics, who looked at what the possibility for substantial additional progress means. The red line is the December Fed meeting when they adopted that idea. The yellow line is 50% progress since then. And the blue line is the 3.5%. They don't have to get to that 3.5% to start tapering, according to the Bloomberg Economics analysis. Here's what they say. If you get to 50%, that would mean 50% from December, that would mean unemployment would fall to 5.1%. That's not that far from the 5.7% that we are expecting tomorrow. They are also talking about inclusive growth for minorities. Well, the black unemployment rate would have to fall to 7.9%. It was 9.9% in December. Hispanic, 6.9%, and Asian, 4.2%. Those are perhaps realistic goals. Keep an eye on those. If we get in the neighborhood of those numbers, then we might bring tapering forward as a debate.
Mike McKee, thank you, sir. Thank you very much. I loved Kit Duke's response to all of this from SocGen this morning on Form in his morning note. This is what he had to say about the outlook for the U.S. economy. If you're 100% or even 90% confident that you know what state the U.S. economy will be in this time next year, you're smarter than I am. I'll include myself in that. And if you know who will the Fed chair will be and the vice chair will be in a year's time, likewise. Lisa Shallot, looking out a year ahead, how difficult is it?
I think it's impossible, but I think the one thing we can be reasonably comfortable with is that economic growth is not going to be 2%, and I know that some of my fellow panelists have asserted that that's where we're decelerating to. I just don't see it. I think we have, record global monetary accommodation. We're about to have sustained next rounds of fiscal accommodation, and this is a economy where, yes, in the second quarter, we missed peak GDP estimates from some of the folks in consensus, but all that has been attributed to inventory building. I think that this is an economy that's still only 75% open. And therefore, the likelihood that you're going to have above average GDP growth over the next year or two is very, very high. And I would love, to see people's logic to help me get to 2% from here. We're running at a 6% rate. And we haven't even gotten near, as the point has been made, to maximum employment. So I think that this economy has a long way to run, and we haven't even begun to talk about some of the dynamics around capital spending and housing and what makes this cycle different.
Well, Lisa, we're lucky this morning. How on earth do we get back to 2%? Here's a man calling for it. A move back to 2% inflation, a move back to 2% GDP growth. Krishna, what is the road, the path towards that?
Well, so, you have to recognize as to the superior growth that you're seeing is coming off of a really low GDP environment in 2020. I think once the fiscal stimulus is in the rear view mirror, which would be by the end of this year, I think the likelihood that any new fiscal initiatives that is paid for will continue to provide you the same level of support is just unrealistic. I think the structural issues with the economy haven't been resolved because of all the stimulus that we have had. All we have had is income support. As long as that is the case, I think by the end of 2022, 2% is really a very realistic target for future growth. And I think in that sort of an environment, earnings growth is going to decelerate, and that's something that we have to prepare for.
There's a debate brewing here. We're going to continue it. That was Krishna alongside Lisa Shallot and Erin Kennan. Let's get some breaking news just quickly. Here's Kelly Lyons.
Johnson, breaking news from the Biden administration. Biden will be giving some Hong Kong residents temporary safe haven, deferring removal of Hong Kong residents for 18 months. This includes helping Hong Kong residents with employment as well as student visas. In the statement, the White House press secretary says the action demonstrates Biden's strong support for the people in Hong Kong in the face of ongoing repression by the People's Republic of China. And they will continue to take steps in support of the people in Hong Kong. So a ratcheting up of tensions between the U.S. and Beijing as Biden gives some Hong Kong residents temporary safe haven.
Once again, Kelly, thank you. Thank you very much. Coming up, a view from the C-suite. Uber CEO Dara Khosrowshahi joins us following his company's quarterly results. That conversation is next from New York. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome to our Bloomberg Television and radio audiences. I'm Emily Chang in San Francisco, and joining us now, Uber CEO Dara Khosrowshahi. Dara, great to have you back here on the show. Of course, we're following earnings, beat on the top and bottom lines, but losses, $509 million. I know you say that'll narrow significantly in the next quarter, but the Delta variant is ripping up the playbook yet again. How are you seeing this play out on the roads? What markets are struggling the most?
Yeah, I think it's interesting to see the effect of Delta. Overall, we're really happy with the results. The top line beat. We knew that we needed to get more drivers out driving and couriers delivering because the demand was growing so quickly. So we leaned in to really increase courier supply and driver supply. And we added 420,000 couriers and drivers during the quarter between kind of June and February. Added another 110,000 with Postmates couriers as well. So we're really getting the earner force out there, and it's resulted in top line volumes that are very, very strong. And it's putting us on a path where Q3 losses are going to come down significantly. In Q4, we're going to hit EBITDA profitability as well. As far as the Delta goes, it's difficult to tell what the effect is, except for markets that have closed down. So Sydney, for example, has really shut down. The mobility business comes down, but our delivery business grows very significantly. And we net out, for example, in Sydney at 30% ahead of 19 volume. So overall, we have this great hedge between mobility and delivery. But when we look at city by city, you look at a New York, you look at a Paris, you look at an LA, et cetera, it's very hard to discern any patterns as far as Delta goes. We'll be watching very closely.
We're going to talk about Eats in a sec, but in terms of ride hailing, look, I've taken about 10 Ubers in the last month after not taking any for a year and a half. Sometimes it's there in 2 minutes, sometimes it's there in 20 minutes, sometimes, you're welcome, sometimes I get canceled on. So when do you foresee a more consistent balance of supply and demand?
So Emily, this is exactly why we really leaned in Q2. We wanted to get the Uber service back to predictable prices that you can expect, ETAs that you can expect. And ETAs and prices are coming back to historical levels. In states like Texas, Florida, et cetera, they're getting there faster. New York is in better shape. So it's really location by location, but we are consistently seeing ETAs and prices come down. I think that by September, October, November, you're going to get that magical Uber experience that you've always been used to. And we're leaning as a company to get there as quickly as possible.
And you're spending a lot to get drivers back out there, $250 million in the last quarter, but you've said you can taper incentives through the rest of the year. Lyft says they're amping up their incentives. So what makes you so confident you can win drivers back if you whittle yours down?
Well, because we're seeing the drivers come back. 420,000 came back in just a couple of months. And what we're seeing in July is, we started with incentives to really get drivers out there, but we're moving from essentially incentives to improving our onboarding processing. We reduced onboarding time by 90% with a new, much smoother onboarding process. We're reaching out to drivers who had stopped driving to resurrect them to get back on the road. That has been enormously successful as well. So in July, for example, we were able to taper incentives. We're targeting them much more specifically in the cities where we needed, when we needed. And at the same time, new drivers who signed up in July were up 30% month on month from June. So we're seeing the numbers, they're really encouraging. And we're not assuming that we're going to get any better, even though based on our technology and the systems that we have in place, we do think we can get more targeted and better in terms of onboarding drivers and couriers.
And obviously, profitability, really important milestone. You've promised you're still going to hit that before the end of the year. But what are the chances that Delta could shake that up too? What are the chances you don't hit that milestone?
The good news for us is that we have the hedge, right? So if mobility gets hit because of Delta, we see the delivery business growing. And we've also stated that the delivery business is going to get EBITDA profitable by Q4 as well. So we think we're reasonably protected. Obviously, it's a very, very uncertain environment, but we're the only company out there that's leading in mobility on a global basis outside of China, that's leading in delivery on a global basis outside of China. These businesses are now strengthening each other. And actually, customers who use both mobility and delivery account for nearly 50% of our gross bookings on a global basis. So if you stay home, you're going to use Eats. If you want to get out to a restaurant, you're going to use classic Uber. That is a strength and the unique strength that we bring.
Now, last time we spoke, you talked about how you've basically built another Uber. There's Uber ride sharing and Uber Eats. When you look 5 years out, which Uber is bigger? You're obviously expanding into grocery, you're expanding into instant delivery. But how do the two Ubers still twins or something else?
Emily, you're making me choose between my kids. I'd much rather have them compete. We've got a team that's growing our Uber business. We've got a team that's growing our Eats business. They're going to compete with each other. And we'll see who wins. I do think that the delivery total addressable market, we've expanded delivery from just restaurants now to grocery. We're getting into alcohol delivery. We're delivering for Apple. We'll deliver an iPhone to your home. So the total addressable market for the delivery business is probably bigger. But as it relates to Uber, we're getting into transit. We're wiring up taxi cabs, two-wheelers, three-wheelers. So it's going to be a great competition, and I'm going to be pushing both of them to grow as fast as possible.
You are doubling down on freight, bought Transplace last month, $2.25 billion. That makes software that helps companies manage their supply chains, manage logistics. What's the vision to own that? What's the vision to own supply and logistics?
Well, I think you hear all the time now how supply chain has become a problem for a lot of companies and is becoming a much more important part of how they operate. 50% of Uber Freight's customers are actually consumer packaged goods makers, brands, et cetera. The same brands that we're delivering for, Corner Shop into your home. So we think with Transplace, we're going to be helping these brands actually manage their supply chain. With Uber Freight, we are connecting them to the shippers that can get the food or the water or the sodas or the beer from the warehouse to the store. And with Eats, we can get that soda or food from the store to the home. There's no one else that is building this kind of end-to-end logistics infrastructure powered by machine learning that understands where you are, when you are, and can make that chain the most efficient. That's really what we're building. And the Transplace team is just dynamite. So we would be very happy to have them as part of the Uber family.
You've pushed back your return to work. You're mandating vaccines for your corporate employees. You did have a COVID exposure at a board meeting. And look, the Delta is real. It is scary. You're not mandating vaccines for drivers. How are you thinking about this? Instacart CEO just told me they're debating it for shoppers. Is it at all on the table?
It's these are subjects that we talk about all the time. I do think that it's different when you're talking about employees or spending 8 hours a day in an office. And remember, for us, the big issue is if we mandate it for drivers, I think we'd have to mandate it for riders as well. And when you have a company that has essentially 100 million riders and drivers using the service every single month, I don't think that to have a company have the power to mandate vaccinations over 100 million people who are moving around is probably the right call. So we are going to work with governments based on government mandates, local mandates. We're going to follow them. And at the same time, we're pushing very, very hard to help drivers, couriers, riders get vaccinated, often providing vaccinations for free or transportation to vaccinations for free. So we're absolutely doing our part.
We are coming up on your 4-year Uberversary, so congratulations on that. The New York Times recently called you the dad of Silicon Valley, a stark contrast to your predecessor. As you look out on the next 4 years, from a cultural perspective, what are your priorities, especially when it comes to diversity and building a more inclusive workforce? What's the company and the culture that you want to build?
Well, I think the kind of company that we want to build They are full of entrepreneurs who want to have impact, and impact in the broadest way, but in real life, right? The service that we are building essentially will allow people to go anywhere, get anything into their homes, and millions of people earn. That comes with a lot of responsibility. So we want entrepreneurs who want to build, but they want to build responsibly. And diversity is a big part of that. We need to have that diversity in our workforce, because we certainly have that diversity in our earner base and our courier base. And ultimately, that is going to help us build a better product. But it's all about impact in the real world. And we got a lot of people who are incredibly excited to build our Go Get vision.
Uber CEO Dara Khosrowshahi, thanks so much for joining us today. Great to have you.
Thank you.
Emily, great work. Great to hear from the Uber CEO. Let's get to this price action right now. About 20 seconds away from the opening bell in New York City. Good morning to you all. The stage set as follows, about 23 hours out from payrolls in America. Futures up 11 on the S&P, advancing 0.25%. That's your opening bell. NASDAQ futures up 28, advancing 0.2%. Here's your bond market. Switch up the board and get to a 10-year yield. Yields look like this, going into a busy end to the week. Your 10-year sub 120, up on a session though by a basis point or two to 119.69. In the FX market, euro dollar 118.41. Unchanged crude up to 68.20, advancing by just 0.09%. From New York, let's get to the market desk and get you some movers. Here's Abby.
John, starting out with the automotive space, we do have some movement to the upside. This, of course, is President Joe Biden has set the goal for electric vehicles or clean cars to be 50% of the cars in 2030. In fact, later today, he's expected to sign an executive order with members of Detroit, the executives of some of those big companies, along with United Automobile Workers. And you can see a big positive response from Tesla, Ford, General Motors. Nikola earlier in the pre-market had been up more than 1%, but turning down just a little bit. Sticking with the car space, we had breaking news over the last half hour. Qualcomm is buying Veoneer for $4.6 billion in cash. This is an auto safety company. It really reiterates the idea that Qualcomm is wanting to go into the car space even deeper. Those shares up 22%. Uber down just a little bit, down 3.4%, as some think that profitability is further out. Etsy plunging, down 13%. Their sales forecast for the current quarter disappointed. And then finally, Moderna down 3.4%. The quarter was okay, but for a stock that's up more than 465% over the last year, John, investors, traders clearly wanted more.
Abby, thank you. About 90 seconds into the session, we advanced by 0.2% on the S&P. Top of the pile, the financials up 0.8%. Bouncing back energy up around about 0.6%. Now up by 1.2% for the energy complex. That's the story for the broader market. Bottom of the pile, healthcare down about 0.4%. Big story over the last week or so. A number of equity strategists upgrading their S&P 500 targets. Goldman, Oppenheimer, Deutsche, all issuing upward revisions since this past Friday alone. Let's bring in Bloomberg's Kaylee Lyons for more. Hey, Kaylee.
Well, John, just today, David Kostin over at Goldman joining the 4,700 club, tying John Stoltzfus over at Oppenheimer as the most bullish on the street. And of course, Binky Shada raised to 4,500 last week. That brings the average among the strategists tracked by Bloomberg for the year-end target to 42.96. The thing is, we're already trading north of 4,400 today. The index, of course, is kind of outrunning strategists here. As usually happens, they are having to play a little bit of catch-up. And Kostin is one of those. His previous year-end target was 4,300, which we crossed on the very first day of the second half. Now, the reason Kostin and the team gave for this upgrade, pretty straightforward. You have higher than expected earnings and lower than expected rates. On the earnings side, we know growth in the second quarter has proven stellar. The BI stocks blended projection shows them up 81.5%, though that is going to be the peak. We're looking at just 24% growth in the current period, 19% in the fourth quarter, and then we're looking at a 4 handle in early 2022. And then on the rate side of the equation, we know that has been a market driver. In the first quarter, when nominal and importantly real yields shot higher, it was painful for big tech, especially with the NASDAQ 100 lagging the S&P 500. Then as that yield story has gone in an entirely different direction over the last few months, tech had started to reclaim its dominance. But obviously, that makes that sector in particular vulnerable to any move higher in yields from here, John.
Kelly, thank you. Let's build on some of this. We've had two big calls in the last couple of days, I think. Citigroup on the one side, Goldman on the other. Let's start with Goldman, raising its price target on the S&P 500 year-end to 4,700. Here's the quote. We expect earnings growth will be the primary driver of U.S. equity returns in the second half of 21 and 22. Lower than expected interest rates support a stable forward PE multiple of 22 times. Citi, taking the other side of this, looking for higher yields, back to 2%. They say the following: the US equity market is more vulnerable to higher real yields because it has a heavy growth stock weighting. Hence, we cut the tech-heavy US to neutral. With us now is Lisa Shallett, Erin Kennan and Krish Mamani, and I thank you all for your patience through the last 10 minutes. It's good to be back with you again around the opening bell. Lisa, how do we work through this? On the one side, we've got this call from Citi, Robert Buckland and the team, looking for a 10-year to get back to 2%, and for that reason, they have cut US equities to neutral. On the other hand, you've got Goldman saying rates will be stable. We like the equity market of 4,700 this year to 4,900 next year. Where'd you come down on that debate at the moment, Lisa?
Well, unequivocally, we at Morgan Stanley are aligned with our friends over at Citi. You know, our perspective is that this market, and certainly the tech stocks in particular, have been extraordinarily flattered in their valuations by a treasury market that's completely distorted. And by our guesses, you know, 40 to 50 basis points below fair value for yields. We know that some of those distortions are coming from the fact that the Fed is you know, roughly 50% of the market. They're a price insensitive buyer, and you know, it's really caused issues here. And ultimately, we think as the Fed you know, signals their intent to normalize policy, as Treasury issuance comes back into the market with further fiscal stimulus, we're going to see the impetus for those rates to rise and for the S&P 500 index to be quite vulnerable with those tech-heavy weighting.
The simpler way of asking this, of course, is to say, do you like international or do you want to stay at home in the US? Erin Kennan, your thoughts on that?
Yeah, I think Europe's sort of interesting here. I mean, the surprise on the growth side last week out of the Eurozone, where consumption really was quite positive, and positive in an interesting way, where countries that, you know, where we'd expect maybe growth to be, you know, lagging in Europe, like Italy and Spain, really outperformed on the consumption front. And of course, countries that tend to be the engine of growth in Europe, like Germany, with their semiconductor challenges, the manufacturing sector has been challenged on the automobile side. So, you know, with that said, we do think that semi issue will sort itself out in the next 12 to 18 months. Europe looks incrementally interesting in that regard. We're starting to see the convergence on the vaccine front, and immunization in Europe is sort of converging towards the UK and the US. And we think the back half of this year may provide a little more upside in Europe than even here in the United States.
I'm just pushing the pieces together for Krish Mamani. And Krishna, it's pretty obvious, if you're looking for 2 and 2, that I imagine you're looking for some real performance in the NASDAQ too.
Indeed. So I think the real question is, what is the rates market telling you? And what the rates market is telling you is, one argument people say is that it's technicals. And I always believe that when you can't explain anything, you put it on technicals. It really isn't that. What the rates market is telling you is that growth is going to decelerate a great deal by the end of 2022. And quarterly growth in fourth quarter probably would be close to 2%, if not lower. In that environment, you know, rates are where they should be, if that's what you're looking forward to. And if rates are correct in anticipating that slowdown, it seems to me the tech-heavy NASDAQ and the tech sector in general, I think, should be the best performing sector. I can't argue that the sector is cheap by any measure that I can come up with, but in the environment that we are in, where rates are low and they can grow at a pretty rapid clip, they will continue to outperform the rest of the market.
Krishna, let's work through this together, just quickly. This is highly unpredictable. I understand that you do, Lisa does, Erin does as well. Just want to work through this with you. If your world starts to materialize, this road back to 2% growth, 2% inflation, all of that good stuff, I imagine the amount of people that have piled into tips will have to pile back out. They'll have to run. When that happens, Krishna, how will things reprice off the back of that? When people have to aggressively get rid of this inflation protection, this insurance they've been buying over the last 6 months?
Well, to some extent, they have already done that, and that's what the rates market is telling you. First of all, tips market is a very esoteric market, so I don't read too much into tips despite all the break-even talk that you hear in the marketplace. I think if there is a technical market in U.S. rates, it's definitely tips. I think that what the 10-year Treasury rates is telling you is growth is going to be meaningfully slower by end of 2022. And that, at the end of the day, that's a much deeper market. And the disjointment that you have seen in certain parts of cyclicals early part of this year and rates market in general tells you that people have unwound a significant amount of positions that they had with that viewpoint.
The reason I asked this, Erin Cannon, I'd like your opinion on this as well. If inflation fears recede, don't real rates have to adjust higher? Isn't that just the logical next step in all of that? You tell me if I'm wrong. What would be the sequence of things off the back of that?
Well, it's a good question, and we don't know. I think that the growth question is key to that, and the ability for the Fed in the midst of massive rise in debt to GDP, and we just spent 50% of the size of our economy on stimulating the economy over the last 18 months. That's going away. I mean, even this infrastructure bill is over a multi-year period. And so, I lean towards Krishna's sort of camp, which is we're going to see significant deceleration in growth rolling into 2022 and 2023. Now, that's not a horrific outcome for equities. You can still grow earnings, and we expect earnings to be, quite strong on a go-forward basis here. And maybe we see a multi-year a move on the equity side due to earnings growth. And so it's not clear to me that the Fed is in this position where they're going to pivot from dovish to hawkish, where we see a rapid deceleration in their QE program, and that we see a rapid rise in rates. I mean, rates are being discussed to rise starting in 2023 at the back half of 2023. In Europe, it's 2025. It's a long way away. And I think there's a lot of data and a lot of uncertainty between now and then.
I understand it's all relative, but we talked about this through the morning. It's really hard to characterize the following statement as hawkish. When the supposedly hawkish president of the Dallas Fed, Mr. Kaplan, says the following: I think we'd be better off to start adjusting these purchases soon. My comments on purchases are not intended to suggest I want to take more aggressive action on the Fed funds rate. Lisa Shallett, does that sound hawkish in any way, shape or form to you?
No, not at all. Again, I think, and we've long believed that this is a Fed, that is walking a tightrope, that wants to present themselves as, being very disciplined, as being data-driven, but they are anything but. They are ideologues at this point who have said, in no uncertain terms, we're going to be really, really patient on inflation and let inflation run because we know we need to give us policy room to eventually normalize rates. And we have, policy ambitions around maximum employment, which is a wealth inequality political dimension. So, I think the Fed has made very clear what is motivating them. And I think a lot of this dissection of the rhetoric on a day-to-day basis is just a way for people who are positioned in the market to rationalize where rates are, which is a complete distortion.
Very difficult to rationalize where rates are. Krishna Mamani agrees with you on that point for sure. Krishna Mamani, Lisa Shallett, Erin Cannon. Guys, it's been fantastic to catch up. I appreciate your time through the opening bell. 12 minutes into the session, we need to talk about this earnings season. Quarterly results being met with some muted market reactions so far. With more at the market desk, here's Abby.
John, it truly has been a great earnings season so far for the June quarter, but investors don't really seem to care. It's pretty interesting because most companies are beating earnings. Those companies, though, that have beat both earnings and revenues, the stock's up just 0.9%. But when we have a double miss, missing both earnings and revenues. The stock's down 2.6%. In other words, the reward not being matched by the degree of punishment. Now, this could have something to do with the guidance, because guidance for the upcoming quarter, this current quarter, in fact, the third quarter, is been reduced by 29%, the most since the second quarter of last year, of course, in the heart of the pandemic. So some folks, traders, investors, perhaps taking that as a little bit of a warning as far as what's going to come as earnings guidance does come in. But returning to the current quarter, John, we are at a record relative to the number of companies that have, in fact, beat on the bottom line, 87%. Whether this has to do with the pandemic low or, since this is over the last decade, management teams seem to be managing expectations well, but not being rewarded, again, by investors and traders.
Abby, thank you. Great work, as always. In your equity market, 14 minutes into the session, we advance a third of 1% on the S&P 500. Coming up, is this a risk to this market rally? China imposing new restrictions on travel in an attempt to curb a Delta variant outbreak. That conversation is next. From New York, this is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Just look at the cases in China right now. It's probably the worst wave they've had since the original wave.
The more important thing is probably that also the import demand from China, which has done its effects on European growth and global growth.
Australia, China, they have a real challenge on their hands for the next couple of months.
The risks of a relatively heavy-handed intervention is real.
Definitely headwinds are coming. for the economic recovery.
Investors warning of mounting headwinds with China imposing fresh restrictions. The measures coming after the latest Delta outbreak spreading across 15 provinces. With us now for more is Michael McKee. Hey, Mike.
John, it is a concern. There are not a lot of cases, even though, as Jens said, it is the most number of cases since the original outbreak. There's only about 500 so far, but it's spreading quickly, and that is a concern because this is the Delta variant, much more contagious. Kaylee took you through a lot of the restrictions that China has imposed at the top of the hour. What's also important is that the Chinese vaccine is not as potent as the Western mRNA vaccines, and it loses some potency against the Delta variant, as do all of them. So this could be a real problem for the Chinese going forward, and we're already seeing some economic impacts. Car sales, property sales in the biggest cities have fallen in the last couple of weeks. Oil refinery run rates are down for a third week in a row, and construction activity, which stalled in June, was supposed to accelerate in July, and it did not. It's sort of just staying where it is. Online search engine data, though, the only good news here, searches for Xie, losing job in Chinese, are a little changed. We're waiting to see what impact that has. But as you can see, we're starting to see markdowns in Chinese growth forecasts. 4.1% now for the end of the year, quarterly year-over-year growth rate, and that could go even further down. Obviously, there's been a lot of news about China and Chinese markets lately, the Delta variant becoming just the latest complication.
Mike, that number 500, more than 500 cases. Now, some debate, how much more than 500 cases there actually are in China? We can put that to one side, but quite clearly the tolerance level in places like China, places like Australia, is very, very different to what we've seen in Europe, the UK, and the United States. Can you walk me through that? Just the different strategies here. There's an elimination strategy in China and Australia, and there's something totally different elsewhere.
Well, they're also a little bit different, too. The Australians tried to keep the virus out and succeeded for quite some time, but the Delta variant being so contagious, it's now in. They delayed vaccinations, but they do have access to the Western vaccines. The Chinese vaccine, as I mentioned, is not as effective as the Western vaccines, and that may be one reason the Chinese are turning to lockdowns, but they also have the command and control economy that enables them to do that, and it worked for them the first time around. So they're going to stick with it for the time being.
Seems crazy. How much longer can you keep doing the same thing for? Mike, that's the situation we're in. It's a crazy one. Michael McKee, in many ways, it's a sad one too. Our international economics and policy correspondent. Your equity market up a third of 1% on the S&P, about 21 minutes into the session, on the Nasdaq advancing by a similar amount. Let's get you the sector price action with our stocks there.